Today, we are going to start looking at how the top management of an organization or the strategic level is able to govern the organization. What are the key requirements that can help us also leverage to achieve the organizational objectives? Because without proper governance, the organizational objectives may not be well achieved. That is why we need corporate governance. I hope that is okay. So let's start looking at what corporate governance entails. What corporate governance entails. If you can see my screen, you post in the chat section. Okay, so corporate governance. When we talk about corporate governance, what is corporate governance? Now, corporate governance has a lot of definitions, but in simple terms, corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. So in any way that a company is directed and controlled, we call it corporate governance. So the ability to direct and control something means you are a governor. You govern, also the financial and operating policy decisions of a particular organization. Now, one thing you must know and understand is this, that anytime you are looking at corporate governance, it actually encompasses the relationships between a company's management, its board of directors, its shareholders, and all other stakeholders. That is why we looked at stakeholders and their expectations, because we have to be able to govern the entity and look at how this governance has interactions with other stakeholders. Now, the primary goal of corporate governance is to ensure that the company operates in an ethical, transparent, and accountable manner, while also maximizing shareholder value. Now, when you look at an organization's objectives, the main objective of every organization, or the main financial objective, is to maximize shareholders' value or shareholders' wealth, and also safeguard the interests of all other stakeholders. Now, we know the various models for assessing stakeholders, and we know how to know or devise or settle or manage the expectations of particular stakeholders. Now, corporate governance sets the framework for how decisions are made and how power is exercised within a company. It provides guidance for the distribution of rights and responsibilities among various parties who are involved in the company, including the board, the managers, the shareholders, and all other stakeholders. So these guidelines promote fairness, integrity, and accountability in the company's operation and their decision-making process. So why corporate governance? How did corporate governance come about? In the past, there were some corporate scandals, okay? So the fall of big companies that people lost a lot of investment in, and that is what necessitated the need for corporate governance. I get it now. In the past, in the 1700s, the South Sea bubbles happened, right? And that was the first well-documented corporate governance failure, where they weren't taking care of what companies, and that they fell. The stock market crash in 1929 in the US was one of it. How were these companies able to go down and crash the market? The global financial crisis that happened, the fall of Enron, the Barings Bank, the Asian crisis, I get in the mid 1997. So there were a lot of corporate scandals that happened over the years. Now, some people used off-balance sheet financing, and then let's say they've taken a lot of loans, and also outside the accounting books, but the business looked to be what? Successful, and they were making a lot of profits. So everybody was fine until they realized that the business was collapsing. All the other people decided to claim their stake in the business, and the businesses were going down, meaning there were no appropriate structures put in place to look into how the business was actually operating, no proper controls, no proper oversight. So people were doing whatever they wanted to do. Okay, so what are some of the things that necessitated the need for corporate governance, right? So there are several key forces that brought corporate governance. One is the regulatory environment. Because laws, regulations, and corporate governance codes are changing, they drive the development of corporate governance. So government and regulatory bodies establish frameworks and guidelines to ensure that companies are quite transparent, Are you getting? They are accountable and ethical in all their corporate practices. Then we have shareholder activism. Okay. Now, shareholders, particularly the ones we call institutional investors, where many institutions, government institutions, and other institutions come together to invest in your company. Sometimes they exert pressure on the companies to improve their governance practices. Okay. They demand increased transparency, board independence, executive compensation, alignment, and shareholders' rights to protect their interests and enhance their shareholder value. This is one of the reasons why now corporate governance is a key issue, or these are some of the driving forces. The third is globalization. Okay. Globalization and the integration of various financial markets, the stock exchange, the futures markets, and also now on the internet, you can invest in any market because now they've come together, right? All on one platform. You can buy crypto, you can buy shares, because now they've integrated all these markets. It has increased the need for consistent corporate governance standards all over the place, right? So multinational corporations and cross-border investors now seek to align their governance practices. They want to maintain what? A certain standard way of governance, not so to provide investor confidence and facilitate international investment, because when we have one set of standards, it may make it easier for companies who have divisions elsewhere to be what? Regulated or governed easily. Then I told you earlier when we looked at also the corporate scandals, no? So high-profile corporate scandals and failures that have happened in the past have actually highlighted the importance of strong corporate governance. And scandals such as Enron, the fall of WorldCom, Lehman Brothers, Barings Bank has led to public outcry, because people are saying that people are not being honest, want to see what is actually going on in the company that is making companies collapse, right? So because of all these things and the need for more robust governance mechanisms, I get in it. We do corporate governance to prevent the happening of those things. I get it, that happened in the past, companies falling and so on and so forth. Now, also investors' expectations are one of the key drivers of what corporate governance. Investors are increasingly concerned about the governance practices of the companies in which they invest. Okay. So they are scared. A lot of people are scared that, okay, when I invest in this company, am I sure I'm going to get what I want? Are they governed well? Are the managers doing something fishy? Not so. So the investors are increasingly concerned about the governance practices of the companies in which they invest. They expect transparency, effective risk management, the accountability of the board, and sustainable practices. Now, companies with strong governance frameworks are more likely to attract and retain what? Investor confidence. If an investor, for instance, know that you have various committees, he's satisfied because he feels like now people are looking into your affairs, so he may not lose his money. Also, we have stakeholder pressure as one of the key drivers of corporate governance. Now, stakeholders, including what? Employees, customers, suppliers, and the communities, are demanding responsible and ethical behavior for companies. Also, so the companies, now people want all companies to act in an ethical manner. They expect the companies to adopt sustainable practices, to consider social and environmental factors, and demonstrate corporate citizenship. And the corporate governance structure seems to what? Deal with all these issues. I hope that is okay. Now, another reason that brought the need for corporate governance is institutional investors and proxy advisors. Now, these institutional advisors and institutional investors, I'm not showing a whiteboard, I'm showing my screen. I don't know why somebody said you cannot see my whiteboard. Can you see now? It's not a whiteboard, it's a screen. I'm not writing. I'm showing my textbook. Now, institutional investors, such as pension funds and asset managers who invest in companies, play a significant role in shaping corporate governance practices. Now, their active engagement with customers, with companies, with other suppliers of the companies, and so on and so forth, tells that some people are doing something fishy most of the time. Are you getting it? So when they engage with companies, voting on their shareholder resolutions and collaboration with proxy advisors, it influences how corporate governance norms and regulations and rules are applied, right? Because these people have invested heavy money into the company. So for instance, if all of us have invested in SNET and SNET invests our funds, elsewhere, our pension funds elsewhere, they have to really be strict on those companies because they've put a lot of people's money in there, right? That is one of the reasons why corporate governance is a key issue. And also because of technology and information accessibility. Now, because technology is advancing and the widespread availability of information have empowered the shareholders and stakeholders to access information about a company's governance practices. And also, this has increased transparency and scrutiny. And also, because of this, it promotes the adoption of best practices and discourages poor corporate governance behavior because everything you do, people record you. Everything you do, people post it online. So it has driven the need for corporate governance practices. So when we look at the driving forces, we saw what the regulatory environment bringing the need for corporate governance, shareholder activism, globalization, corporate scandals that happened in the past, investor expectations, stakeholder pressure, institutional investors and proxy advisors on the board, and technology and information accessibility. So these are the things that have brought the need for corporate governance. So now we know corporate governance, what brought corporate governance and the key driving forces, right? Now we have to look at the pillars of corporate governance. So what does corporate governance stand on or stand with? These are also, you can also call this the principles of corporate governance, right? So it depends on how you look at it. But we are saying that if corporate governance will be corporate governance, or if we can govern as governance, which is the board of directors, if we can govern the company well, then there are some pillars we must stand on or we must stand with. Okay, some principles we must go with. So these are all general principles of corporate governance. One, transparency. That's the first one. Okay. So we are saying that transparency refers to the disclosure of accurate and timely information regarding the company's financial performance, operations, and their decision-making processes. So transparency ensures that all your stakeholders have access to relevant information to make informed decisions, meaning that for corporate governance to be good, we must be transparent. We must disclose information that is required to be used, right, by the people or by the owners or the shareholders and other stakeholders to make informed decisions. Are we okay? The second is equity. Okay. Remember, equity is not the same as equality. They must not be equal, but they must be treated fairly. So equity signifies fairness and equality in the treatment of all stakeholders, including shareholders, employees, customers, and suppliers. So it involves protecting the rights and interests of stakeholders and avoiding any form of discrimination or favoritism or nepotism, right? So we are trying to what? Treat everyone fairly. Are you getting? So that is what we mean by equity. So this is one of the premises or one of the principles that we stand on for corporate governance. Third principle, honesty and integrity, another important pillar. Now, honesty and integrity are essential principles that guide ethical conduct in corporate governance. It involves maintaining high moral standards, adhering to ethical norms, and acting with honesty and integrity in all your business dealings. So being honest, being straightforward, being probe, are you getting it? Not being associated with any misleading information of some sort, right? That means you are being honest. That's integrity. Now, responsiveness is the next principle or the next pillar. And responsiveness refers to what? Your ability to address the concerns and needs of your stakeholders promptly and effectively. So if people are facing problems, your stakeholders are complaining, customers are complaining, how quickly do you respond to them? That is what we call responsiveness. And one of the jobs of the board of directors is being able to respond quickly. If management raises an issue, you should be able to deal with it immediately. Not so, because of bureaucracy, sometimes responsiveness is a problem, but gradually, various boards are working on responsiveness. How can the board respond immediately to the issues of the executive directors? We'll come and look at what we mean by executive directors. I hope that is okay. So that's responsiveness. So it involves actively engaging with our stakeholders, considering their perspectives and taking appropriate action to address their interests. Okay, so we've seen transparency, equity, honesty, and integrity, responsiveness. Now let's look at other ones. So we have what? Efficiency and effectiveness. When we come to efficiency and effectiveness in corporate governance, it involves optimizing our resources and processes to achieve what? Our objectives. Remember, we don't have to be slow. We have some particular objectives, which is a long-term objective of the company. Remember, we looked at strategic planning. And as a result of that, we want to go to what? Put in some strategies to achieve our objectives, okay? So in effective decision-making, allocating resources and continuous improvement of our practices will be geared towards, will bring about goal congruence. It will help us to what? Work hand in hand to achieve what? Organizational objectives. Because strategic management is the skill or art of formulating, implementation, and what? Evaluation of cross-functional decisions to what? To enhance coordination in the achievement of organizational objectives. Meaning that all the various functional heads of an organization must work together, meaning they must all be congruent, they must all be following the same train to go to the same destination. So that's effectiveness and efficiency. Actually, efficiency is your input-output capacity. Did you put in, when you put in 1, do you get the same 1? Or when you put in 1, do you get 2? Or when you put in 1, you get 0.5? That proves how efficient you are. And effectiveness is actually achieving your goals. So if I wanted to produce 5,000 soaps, I put in some units of materials, right? Now, if that 5,000 soaps is being able to be produced, I've been efficient because I was able to produce the 5,000. Not so, if I was supposed to use 5,000 labor hours, I use 6,000, I've been inefficient. Have I been effective? No. So effectiveness is when you have actually achieved the specified objective. I hope that is okay. The next principle is high ethical standards. Now, high ethical standards encompass promoting ethical behavior, integrity, and adherence to ethical codes of conduct. This involves establishing ethical guidelines, promoting a culture of ethical standard, and holding individuals accountable for their actions. So this is where we promote good ethical behavior. So for instance, when there are a lot of what dilemmas in the organization, people are facing ethical problems, we have to make sure that they will be penalized or there will be some form of what punishment that they are going to face so that people are not going to be involved in immoral or unethical behavior within the organization. So the board have some particular ethical standards which they have to follow. For instance, an accountant has 5 major ethical principles he needs to follow. And when we get to ethics, we'll look at it in detail. Now, the next principle is professionalism. Now, professionalism relates to your competence, your expertise, and your whole professional outlook, also when you are serving in particular governance roles. So it involves appointing qualified and experienced directors, executives, advisors who possess the necessary skills to fulfill their responsibilities effectively. That is professionalism. Then the next and most important one is accountability, a fundamental principle of corporate governance, and it involves holding individuals, particularly directors and executives, accountable for their actions, decisions, and performance. This includes financial accountability, like maybe the financial statements that you are doing. Maybe you have some particular bonus you have to achieve, some particular rate you have to achieve. Have you been able to achieve it? Compliance with laws and regulations, responsibility for the company's overall performance. Okay, then we have leadership. Okay, leadership refers to the role of the board and executive management in setting your strategic direction, overseeing your operations, and ensuring sound governance practices. Now, effective leadership involves providing guidance, making informed decisions, and acting in the best interest of the company and its stakeholders. Okay. Then we have independent assurance, supposed to be independent assurance. Now, independent assurance refers to the independence and objectivity of individuals serving in governance roles, such as independent directors and auditors. So when we talk about independence, we mean that these people have no sort of bearing on the company, the objective, and they have integrity. It means that they do not have any conflict of interest, any connection, right? That would what? Cloud their professional judgment, okay? So it ensures that there are checks and balances in place to prevent conflicts of interest and promote unbiased decision-making. So these elements collectively contribute to the establishing a robust corporate governance framework that promotes accountability, transparency, and ethical behavior within the organization, ultimately enhancing stakeholder trust and confidence. And that is the main reason why we have these pillars, because corporate governance is all about what? Stakeholder trust and confidence. Because remember, no matter the strategies that you adopt, right? If it's not suitable, it's not feasible and acceptable, then it is not an appropriate strategy to achieve what? The organizational objectives. You get the idea? So when we talk about what? Acceptability, we are saying that the strategy that we are going for, are you getting it? Our stakeholders should accept it. Primarily, our shareholders should accept it. So let's say this is our CEO, right? This guy likes risky investments, okay? Risky investment. Now we produce soaps, and this guy wants us to immediately diversify. Also, he has seen that betting brings a lot of money. Then from selling soaps, this guy intentionally decides to what? Diversify into betting, right? This guy is a risky guy. Maybe your shareholders are risk averse. So when you are taking any strategy, you have to get what? Your stakeholders trust, and they should have confidence in the strategy that you have taken. So if you are into soaps and all of a sudden, because you have a risk attitude, you are a risk seeker. Not so. When we say somebody's a risk seeker, he likes risk. Not so. This guy is a risk seeker. Shareholders are risk averse. They do not like risk. Then you move directly from soap into what? Into betting. It's not a good idea, right? Because the people, you have not consulted them. That is why all these things are important before you even pursue strategies. We have to look at it from the top level of management. What is their say on it? I hope we are okay. So before we even pursue any strategies, corporate strategies like diversification, it's a board duty. It's the board of directors that decide what should be done. Is that okay? So that is it. So we look at some particular theories that underpin corporate governance. There are a lot of them. And then we are going to focus on some key ones. For instance, things like the agency theory and the stewardship theory have a lot in common. I get a resource dependency. We'll look at all of them. So corporate governance theories provides different perspectives and frameworks for understanding and analyzing the dynamics and relationships within corporate governance systems. So here's a brief explanation of each of the mentioned theories. Okay, once you get the idea, you can always use your mind to write a lot, right? Because they are just so similar. Now, the first one is the agency theory. Now, this theory focuses on the relationship between principals, who are the shareholders, right? They own the resources. They are the principals, and agents, which is the management of the company. It examines the potential conflict of interest that may arise due to the separation of ownership and control. Remember, when you look at a company, right, there's divorce of ownership and control. The owners, who are the shareholders, also, are at the top. They don't know what's going on because they are not actively involved. So they have appointed the agent, who is what? The management or the directors, not so the executive directors, to oversee the operations of the company, right? So these guys are actually agents, and at the end of the day, they end up what? Building their own wealth. I get it. Instead of building the wealth of the owners. I get it. So that is basically what? Basically the agency theory. Are we okay? So this one examines the potential conflicts that may arise. Now, the agency theory suggests that managers may act in their own self-interest, which I was telling you, rather than maximizing shareholder value, and mechanisms such as what? Performance incentives and monitoring can help align the interest of principals and agents. Do you get it? So problems with the agency arrangement may include what? Conflict of interest, not so, and also oversight. Sometimes directors may be negligent or miss something because it's not apathy, right? Because it's not theirs and it's somebody's, and no matter what you do, the person will still be paying him. He doesn't put in the necessary effort, right? So he may miss a lot of things. One, lack of integrity and honesty. What really happens? This is some of the things that happen, right? So you have to make or buy a component. Okay, so we'll look at the transactional cost theory. Now, I have to make a component in-house. And when I'm making this component in-house, it's going to cost me, let's say, 10 cedis per unit to make, right? Now, I buy from a supplier, and the supplier is going to charge us 12 cedis per unit to make. We would have chosen the 10 cedis, is that not so? Now, maybe the supplier's amount is even lower than the 10 cedis, but because we are buying from outside and no one within the organization knows how much it's actually going to cost, we are going to tell this guy that, you know something, increase this price to 15 cedis, and let's tell them that this price is the best. Meanwhile, when we could have made it at 10 CDU, they will go and lie and tell the people that, oh, when we build it in-house, it's going to cost us 18 cedis per unit to make. Very expensive. Let's go with the supplier. So that 3 CD per unit, this guy is going into his pocket, right? To go into the director's pocket. And what happens is that if you are producing 500,000 units at 3 cedis each, this be money, right? This guy will end up making about 1.5 million Ghana cedis extra cash, which is going into his bank account. If cement, the guy will steal a lot of it, right? He will dilute with so much water that if we are building, the buildings are not going to be strong. So these are some of the things that a lot of directors are doing. They are not being honest. And most of the time, they are doing fraud. They are engaged with misleading information. That is why some of these things happen. Sometimes they do creative accounting. They do not report what is there. They do so many transactions in cash such that you are not going to trace the source of the transaction, right? And they violate ethical principles, okay? So they may deviate from the values and ethics of the shareholders. So these are some of the things directors do to boost or encourage their own self-interest, okay? So let's look at conflict of interest. Now, directors have a fiduciary duty, a duty of care to act in the best interest of the shareholders. Now, conflict of interest means that the director's personal interests surpass the interests of the shareholders. That is that directors lose their independence, integrity, and objectivity, okay? Now, directors must solely work for the best interests of the shareholders and avoid their personal interests at all times. So what happens most of the time, all these things are because of conflict of interest. That's why they work to increase their own wealth. One, like the make or buy decision that I was saying, right? Instead of subcontracting it to somebody who can do the work, he realizes that, oh, my sister's son has some cement company here. Let me give the work to him. Are you getting it? Sometimes we have an investment, right, which will yield us maybe returns, maybe year one, it will give us 100 million cash flow. Year two, loss. Year three, loss of 400 million. Maybe year five, not so, or year four is going to give us an overall loss of what? 1 billion, right? But because in the earlier years, it is giving us profit, let's say year two was profit 200 million, right? The managers are going to take this investment. But when there's an investment which the first year is giving us a loss, right? Second year is giving us a loss. But the third year is giving us what? Profit of maybe 5 billion. The managers will not take it. Why? Because of short-termism. They want to increase what? Their wealth in the short term. This is what we call short-termism, right? So they focus on short-term profit to maximize their own bonus for the year, because this 100 million, he's going to get bonus. The 200 million the next year, he'll get bonus. But why would he be concerned about something that will not give him profit in the earlier years and in the future years where maybe he may not even be in the company, right? Profit is coming. He's not there. And you ask them, you say, Charlie Massa, man for pay school fees. So we must pay school fees. We want bonus today, not tomorrow. Tomorrow, what if you are not here? We are in a different company. So that's the mentality that most of the directors have. And sometimes they negotiate high and unjustified remunerations. Okay. So if usually the normal remuneration on the market for a director is about, let's say, 20,000 Ghana cedis. Also, this guy wants to be paid 45,000 because a lot of people are being paid in this category. Meanwhile, the other people who are being paid in this category are not in that kind. So when you are looking at remuneration, you also have to look at the industry you are operating, right? The industry decides the amount of remuneration you are going to get. And sometimes they accept personal benefits from third parties. You remember when I was talking about that make or buy relationship, the make or buy thing, right? So personal benefits, loans from parties, they take loans, they do not pay, they run away, and the company has to bear the debt. All these things are some of the conflicts of interest that what directors what use to create their own wealth. Are we okay? Now, one thing is that when it comes to the agency theory, remember, we look at your duty of care or your fiduciary duty, which means your duty of utmost faith, good faith towards the shareholders, which are the principals. This means that directors should act in the best interest of shareholders and avoid any conflict of interest or disclose potential and actual conflict of interest. So these duties can be legal or ethical. Okay. So when we get to ethics, we'll look at Carroll's 4 responsibilities. We'll look at all that. Now, accountability. The agent, which is the director, is fully accountable to the principal. Now, directors individually and collectively have a duty under corporate governance to run the company in the best interest of the shareholders and to be held accountable of the results and the outcomes. Okay, so directors can be accountable in the following ways. Okay, so scrutiny of their performance by non-executive directors. So there's a need to bring non-executive directors on board, and they are going to what? Appraise the director's performance. Also, another way of checking the agency relationship or the agency conflict or the agency theory is actually to link the director's remuneration with their performance, right? So if somebody is not performing well, when you give him performance linked remuneration, because he wants to get higher remuneration, he's going to perform well, right? So that one will mean that there'll be a direct relationship between his remuneration and his performance. So increase in what? Performance will lead to what? Increase in their remuneration, right? This is one way. Sometimes we will not appoint the director, right, upon completion of his tenure, so that somebody else can come and operate for us to see. So that is some of the ways we check. And sometimes we can even what? Give them what? Performance. We can even give them what? Equity. Okay, so sometimes we issue shares for the directors. We make them equity holders as well, so that they'll be concerned, right? Now, these are ways to control the agency theory. And remember, all these things I was talking about, you realize that we will still have to incur costs, right? These agency costs, these performance-related pay, bonuses, equity, all those things that are going to check these people. For instance, one of the ways to check them is bringing in what? The auditors, right? Auditors to check. And auditors will still come with cost. Audit comes with huge cost. So because of that, we have cost of agency. We incur cost, right? To monitor the directors to see whether what they are doing is right. No, so the first one we have, there are 2 types of agency costs mostly, which is what? The monitoring cost, which is the remuneration of the directors, cost of monitoring them, audits, attending AGMs, annual general meetings, bringing NEDs on board, just to monitor them. We put all these costs into play. Then we have the residual loss, which are the costs beyond the remuneration of the directors, like when there's a conflict of interest by the directors, leading to what? A loss in the business or a loss to the shareholders, right? So there are costs that we intend to monitor them, and also all the costs and all the incentives we give them just to monitor them, right? And there are costs that we will incur because we have either lost reputation because the directors are not doing the right thing or the business has collapsed. You get it? So these are the various costs of what? Agency. So that's the agency theory. So if it pops up, be ready to what? Comment, be ready to talk about it. Do you get the whole idea? Now, the next theory is the stewardship theory. Now, the stewardship theory is just like the agency theory, but here we look at it as what? A steward and what? An asset owner. So stewardship theory assumes that the managers are motivated by a sense of responsibility and stewardship towards the company and its shareholders. It suggests that managers will act in the best interest of shareholders because of their intrinsic motivation to protect and enhance the value of the firm. So here we are saying that, okay, if the owners, also the owners have their assets, that's so The owners have their assets. They can give it to what? A steward, not so. They can give it to a steward. You get the idea? So the steward is literally the director who is keeping the assets of what? The owner, who is the shareholder, what? Safe. Not so. It's giving it to the owner. Now, the whole thing is that these people, sometimes just like the agency theory, will not act in the best interest, right? But then with some small motivation, right? Some small motivation, like giving them bonuses, giving them performance-related pay, and also giving them some benefit like scholarship for their children and other things, it will what? Motivate them to protect and enhance the value of the firm. So that is the stewardship theory, just like the agency theory, right? We must incur some cost to what? Make these guys motivated, also to motivate them to actually what? Achieve the organizational objective or what? Enhance the value of the firm, because we have put our assets in their hands for them to manage for us. I hope that's okay. So the stewardship theory and the agency theory look alike, but here we are looking at stewards and their owners, and the agency theory is agents and their principals. Are we okay? So that is it. The next one is the stakeholder theory, and the stakeholder theory emphasizes the broader network of individuals, I get in groups, which are the stakeholders who are affected by and have a stake in the actions and performance of the company. It argues that companies should consider the interests of various stakeholders, including their employees, who are internal stakeholders, customers, connectors, suppliers, connected, communities, external, and the environment, rather than solely focus on maximizing what shareholder value. So this one comes with the premise that what, yes, it is good to try to maximize what shareholder wealth, but the shareholders are not the only stakeholders. The same way you can be affected by all other stakeholders. If you are saying that you're only concerned about these guys, what about the government? What if you breach some laws and regulations? What if you breach Food and Drugs Authority regulations? What if you damage the environment? How is this going to affect other people? Have you thought about it? That is the stakeholder theory. I get it. So there are a broader network of individuals who are affected by the organization's operations and have the stake in their actions and their performance. Are you getting it? So we have to consider the interests of all our stakeholders. Are you getting it? To ensure that at the end of the day, it will still what? Protect and enhance the value of the firm instead of just focusing on what? The maximization of shareholder value. Okay, so that is the stakeholder theory in corporate governance. Okay, so the next theory which we are going to talk about is the transaction cost economy, so the transactional cost theory. Now, this theory examines the costs associated with transactions or exchanges between individuals or entities, okay? So in the context of corporate governance, transactional cost theory suggests that companies choose governance structures that actually what? Minimize their transaction costs, such as their contracting cost, information asymmetry, opportunistic behavior. It analyzes the trade-offs between what? Internal governance mechanisms, such as hierarchical control, and external governance mechanisms, such as market competition or legal regulation. So the whole thing is that, yes, we must try to what? Minimize transaction costs associated with transactions. But this is not the case with management. If you are looking at it in terms of agency, just like I use the make or buy example, right? This is what normally you see. So instead of minimizing costs, these guys want to contact the outside supplier and what? Give him a contract so that they will what? They will still go for a higher cost and increase money in their pockets or put money into their pockets. You get the idea? Because of that, then we say we haven't met what? The transactional cost economy. We have to be economical, but directors most of the time are not economical. They want to increase their pockets. You get the idea? So some of these things need to be checked. I get it, like contracting costs, the cost of obtaining information from elsewhere, and the way people behave. We have to make sure that what our costs are kept at a minimum so that we can use, we can incur costs to what? Actually achieve our objectives. Okay, so that is the transactional cost theory. Now, the next one is resource dependency theory. Now, resource dependency theory emphasizes the interdependence between organizations and their external environment. Now, this suggests that organizations depend on external resources such as capital, information, and expertise to survive and thrive. Now, the theory explores how organizations manage and influence their relationship with external actors to secure critical resources. Now, you realize that we all interact with the environment, right? So we need to obtain some particular what resources. Are you getting it? And then if we are going to obtain these resources, who are we going to depend on for these resources? How do we build relationship with these people who are going to give us those resources? Right? It's very, very important. Your staff are going to come from somewhere. The raw materials that you are going to use are going to come from somewhere. Are you getting it? Your market is going to come from somewhere. How do you build relationship with these people? So your resources and when they are coming from, you need to build, manage, and influence relationship with the people who provide organizations resources. And that is the resource dependency theory. Okay. So there are a lot of theories actually. If we say we have to go through all of them, it is going to take us days or even weeks. Okay. So we have the managerial hegemony theory and class hegemony theory. Now, these theories focus on power dynamics within the organizations and society. So, managerial hegemony theory suggests that managers may possess significant power and influence over corporate decision making, potentially leading to their self-serving behavior. So, class hegemony theory extends the perspective from where managers possess significant power, not so. But here we look at what the role of the broader societal and economic structures in shaping our corporate governance dynamics based on what is happening outside the organization. Then we have the psychological and organizational perspective theory. Now, these theories examine the cognitive and behavioral aspects of corporate governance. So, how individuals and groups psychology, the decision-making biases, the organizational culture, and societal dynamics impact the governance practices and outcomes. Everybody has his own mind, right? Mind games. How does it work in corporate governance? That's the psychological and organizational perspective theory. Then we have the system theory, which views corporate governance as a complex system with interconnected elements and feedback loops. It emphasizes the need for a holistic understanding of the governance system, considering the interrelationships between internal and external factors, as well as what the dynamic nature of the system. So if you realize the ones that required you to have good knowledge, I went a bit into detail. Most of the time is the agency theory that requires so much, the stakeholder theory and the stewardship theory and the transactional cost theory. I get it. The other ones, you just have to know about them and be able to write about them. Okay, so the next thing we have to look at is to dive deep into corporate governance. And diving deep into corporate governance, there are various corporate governance structures throughout the whole world. Are we okay? So we are going to look at each of them in brief, the various corporate governance reports, and we are going to dive deep into other aspects of corporate governance. Now, the first report I get in it that we'll talk about is the Sarbanes-Oxley Act. Now, what are corporate governance reports? Your examiner can ask you. Now, these are a comprehensive list of some key corporate governance principles, reports, and recommendations from various countries and international organizations like the OECD, the ICGN, and all that, right? Now, corporate governance plays a crucial role in guiding the management and oversight of companies, ensuring transparency, accountability, and ethical practices. Now, let's briefly explore each of the mentioned reports and principles. So the first one is the Sarbanes-Oxley Act of 2002, which is what we use in the US. Now, this one actually was brought up in 2002 because of the corporate scandals that were happening, right? Companies collapsing here and there. Now, it was enacted in the US in response to the several corporate accounting standards, the scandals. It aims to improve corporate governance and financial reporting by imposing strict regulations. Now, that's one thing about reporting in the US is obey before complain, right? So it is strict regulation on public companies. So they follow obey before complain. So they mostly use the rules-based approach to corporate governance. Now we'll come and look at how we derive corporate governance mechanism. So they use rules-based approach, right? Which I told you is what? Obey before complain, right? Obey before you complain. So you can't complain. Failure means you are going to pay penalties, right? So it introduced requirements for internal controls, financial reporting, transparency, and independence of auditors. So the Sarbanes-Oxley Act, some countries, even Ghana, we adopt bits and pieces. Every country adopt bits and pieces of all these ones. But these are the general reports that we usually have, right? So strict regulations on companies. Then we have South Africa, 1994, the King's Report. Now, the King's Report is a significant corporate governance report in South Africa. It emphasizes the principle-based governance, stakeholder engagement, and integrated reporting. So it has served as a foundational document for corporate governance practices in South Africa and even in the world. So you see here it was strict regulation, but here they say what principle-based. So principle-based means that there's a bit of flexibility, right? For you to chip in what you think is right. Because if there's a rule, what if something new comes which is not in the rules? That means somebody can bypass. That is why we use what principle-based approach to governance here. So governance is based more on principle. You do similar things rather than strict mechanisms. Are you getting it? So we'll come and look at the principle-based and the rules-based approach as well. But these are the things that you need to know and understand. Now, we have the Cadbury Committee Report of 1992 for the UK. Now, the Cadbury Committee Report was commissioned by the UK government, and also to address concerns about corporate governance practices. During 1992, it focused on issues relating to what separation of ownership, and also and control, and it recommended the establishment of the UK what governance code. I get it. So here was okay. So the divorce of ownership and control, what issues does it bring? I get it. Because of that, we brought about the other reports in corporate governance in the UK. So another report that we'll talk about is I get a UK corporate governance, because UK has a lot of financials. You know, it's a financial sector most of the time. So they have a lot of reports. We have the Turnbull Committee reports. We have the Greenberry Committee report, and also which was focused on executive compensation and recommended guidelines for setting executive pay and increasing transparency. We have the Hampe Committee report of 1998, which addressed audit committee effectiveness, emphasizing their role in promoting transparency, financial reporting integrity, and independence of auditors. We have the Turnbull report, which focused on internal controls and risk management systems within companies, promoting sound risk management practices and accountabilities in corporate governance. Then we have what Hicks report, which focused on the role of NEDs or non-executive directors and emphasized their independence, effectiveness, and engagement in decision making. Then we have the Smith report, which we mostly hear. If you read most of the books, they talk about what we call what the combined code, right? So this one was an update to the Cadbury Committee's recommendations, and it set out the principles and best practices of corporate governance for listed companies. So there are a lot of reports, right? If we are to look at corporate governance according to the report, students will get confused. So all the things we were discussing, the pillars, all that, they are all found in some parts of these reports. Then we have the EU Governance Forum. Now, the European Union Corporate Governance Forum is an initiative by the European Commission also to promote good corporate governance practices across European Union member states. Then we have the OECD, the Organization of Economic Cooperation and Development governance principles, right? Which is a main theme of your ICA paper. We will look at them also. Now, the Organization for Economic Cooperation and Development, OECD, which is an international organization, developed a set of corporate governance principles aimed at improving governance practices worldwide. Now, the OECD principle of corporate governance provides a comprehensive framework for promoting transparency, accountability, and responsible business conduct. Okay, so we have seen the various reports. So as I was telling, we have approaches for what? Corporate or approach where we do our corporate governance. You remember I told you that what? There are two main ones. There's the obey before complain approach to corporate governance, and there's the you get it. So there are two. Obey before complain and right? That's the principle base. So the rules-based corporate governance refers to a regulatory approach So the regulatory approach, which of the codes that we saw did we see more of the rules-based? Yes, put it in the chat column for me. Which of them did we see the rules-based? Which of them? The reports that we saw, which of them used the rules-based approach to corporate governance? Put it in the chat column for me. Yes, yes, quickly, we have less time. We have less time. Yes. Which ones? Which one did we see the rules-based being applied to? Yes, the Sarbanes-Oxley Act. Somebody said Greenberry. Greenberry was more of principle-based. It was the Sarbanes-Oxley that follows the obey before complain. All the other ones had a little bit. So Greenberry, yes, there's a little bit of regulation, but it was mostly principle-based, right? So when it comes to rules-based governance, right, it follows a regulatory approach that relies on explicit and detailed rules, regulations, and codes of conduct to govern corporate behavior. So it provides specific instructions and requirements that companies must comply with in their governance practices. So that's why I said obey before complain. Now, there are some key features of this governance rule, okay? This governance rule. One, it brings about clarity and specificity. Okay. Now, rules-based governance provides clear guidelines and requirements, leaving little room for what? Ambiguity or interpretation. Because now, when you look at rules and you look at principles, some people are not good with principles, right? So I tell you, if the signal turns green, jump, right? Look at this. And if I tell you, if the signal turns green, jump in a particular way or jump up into the plane. So with this one, if you say the signal tells green, jump, I can jump down into the river or I can jump up into the plane, right? Which one are you specifying? So principle means everybody can do what he wants to do. There's no clarity. I get, and it is not specific because somebody may have so many options. But if I tell you, if the light turns green, jump into the airplane and shut the door, that means it was specific and it was clear to you. You wouldn't be standing there and you will die, right? Because you have to jump up or down. Are you going to the river or you are going into the plane passing by? You get the idea. So that is it. Now, one thing is compliance and enforcement. It facilitates easier enforcement and monitoring of what governance practices, since violations can be identified based on what? Specific rules. Okay. Another one is standardization. Because it is obey before complain, it promotes what? Uniformity in governance practices across companies and industries, ensuring what? A level playing field. So everybody has the same thing, unlike principle where people, so if we are applying when the light turns green, you should all jump up, everybody will jump up. But when we are applying principle, it's not standard. Some people may jump down, some people may go left, some may go right, some may not even jump at all, right? So that is one of the features, which is actually an advantage. So you see the features are broken it into two, the one that is advantageous and the disadvantageous part. Now, with the disadvantages, one, the rules-based approach to corporate governance is rigid. It doesn't change, right? And that's where principle becomes what? Flexible, because of flexibility. This is not flexible, it is rigid. So it may lack flexibility to adapt to unique circumstances or the changing environment. Are you getting it? As it is based on predetermined rules. So for instance, as COVID came, right? Things have changed. The digital economy has changed. So if you are still applying old rules, it may be difficult for you to change because things have changed and you are still in the past. But when it is principle, we can sort of adapt it, right, to the change. Now, compliance focus. Now, and this one disadvantage is that people who are going to apply it will just be focused on what? Compliance, instead of trying to actually not just do the right thing, but improve their business processes. They will just be following what? The compliance. Let me just comply, and that is it, right? It's like a child who you've beaten, he's used to the beating. So instead of correcting his mistake, you say that, oh, whatever I do, mommy will beat me or daddy will beat me after all again. Let me do it. If they beat me, I will not die. You get the idea. But instead of instilling the spirit of good governance into them, they know that they will be penalized after all. So They just do what they want to do and be penalized. You get it? So that is it. If you are focused too much on compliance, people will try to bypass the compliance. And also, it creates a regulatory what? Burden. It creates a regulatory burden. Now, the extensive rules and regulations can impose a significant compliance burden on companies, especially smaller organizations who have limited resources. You want him to comply with all these rules, but this guy just started business. Charlie, give him a break. You get the idea. So that is the rules-based approach to corporate governance. I hope it's well understood. Now let's go to the principle-based. When it comes to principle-based governance, it relies on a set of guiding principles or broad statements of best practices rather than detailed rules. So this one, it emphasizes the underlying principles and values that should guide corporate behavior and decision-making. So the key principles or the key features of the principle-based governance include, one, there's flexibility. And because it is principle-based, it allows companies to adapt their governance practices to specific contexts, considering their unique circumstances and stakeholder needs, and to also adapt to the ever-changing environment. Also, there's ethical foundation. It emphasizes responsible decision-making, promoting a good culture of governance, and also the focus on outcomes. So here it's not just on compliance, but on outcomes, right? So it encourages companies to focus on achieving desirable outcomes. So it fosters the spirit of good governance. What will happen rather than just comply? I can comply, but still not grow my organization, right? Rather than just complying with specific rules. Are you getting it? So those are the key features or some of the advantages too. Then the disadvantage is that what? You may have interpretation challenges because I told you when the light turns green, everybody is doing what he wants to do. So because of that, the lack of specific rules can lead to varying interpretations and subjective judgments, potentially resulting in inconsistencies in what? Governance practices. Okay. Then the next one we have is lack of enforcement. Now, since principle-based governance provides more discretion, enforcement and monitoring can be challenging because there may be a higher risk of non-compliance. You know that because you can't enforce it. What are you going to use to enforce? Everybody is sort of applying the same principle. You said jump. You didn't tell me where to jump. So how can you even inspect? Because if you come and you say I should jump, you didn't tell me where to jump. Should I jump down, up, left, right, forward, center? Where should I jump? No, so it is difficult to enforce. And also there's uncertainty. So because of the absence of explicit rules, it can create uncertainty for companies and stakeholders, particularly in cases where there's ambiguity or disagreement about the interpretation of principles. It's like the tax law. Because it's based on principles, people interpret it in their own way, right? Meanwhile, some tax laws are particularly based on rules. You cannot interpret it in any other way apart from what is exactly given. Are we okay? So it is worth noting that many corporate governance frameworks incorporate elements of both rules and principle-based approaches, which strike a balance between the two, okay? Now, sometimes it may be difficult, okay? But as there will be a balance, and people will be tilting more towards the regulatory side, which is a rules-based, and some will be tilting more towards the principle side. So it's all up to you. Are you okay? So the optimal approach may vary depending on the legal and regulatory context, industry practices, and specific needs and circumstances of the organization, and even the particular country where you operate, that organization operates. Do you know why? Because every particular organization even resides in a particular country. Do you all agree? So in the country where you operate, they may have governance rules. Also, they may have governance rules in their what do we call it? Their corporate companies act, companies code, or other regulatory acts. Are we okay? So it's also important looking at what that aspect says. So let's look at some symptoms of poor governance. This thing you see, this one is more case related. So the things we are doing, some of them are case related. Sometimes you have to check whether the principles of integrity, all those things are being met, right? So we will look at a certain number of cases where I'll give us the forum. And we are all going to discuss what we saw in the case, what you think is happening, what are the corporate governance mechanisms that we can use, okay? I'm going to give you that room to express yourself. So just brace yourselves. We'll start solving some few cases soon. Are you getting it? So when we say symptoms of poor corporate governance, these things, I can say that this is the part where a lot of case studies will be based on, right? Meaning that something will be happening and then this is what you'll be looking at. So with a lot of ICA questions, the structure is mostly family centric. So it's a family business and the people do not want to change, right? They are static culture. And because of the static culture, when you say they should what? Put in appropriate governance structures, they are scared. They don't want to do so. I get it. So this is mostly how ICA cases look like. There's always something happening. I get it. Sometimes something which is supposed to be done by the board, management, or let's say an employee is suggesting that they should do it this way. They should do it this way. You get it? Or that way, which is not his duty. Okay. So the board has some particular rules, or the board has some particular duties they have to fulfill. What is that duty? So when you see any red flag in corporate governance or in a case, bring it up. That's how we do case study actually. When you see red flags, you bring them up. So let's see the first one. Domination by what? A single individual or a few persons. Now, if you look at a case, you realize that the whole case is about one person. He's the chairman, he's the CEO, he's everything. He's also the key shareholder of the organization. No, this tells us that there's no divorce of ownership and control. One person is dominating the whole thing. He's the one taking all the decisions, meaning too much power. Sometimes we use the word unfettered power and also in the hands of one person. Are you getting it? These are some of the things that what we look at. Okay, so domination by a single individual or a few persons. Poor corporate governance may be characterized by what? The concentration of power in the hands of one person or a small group, leading to limited accountability and potential abuse of power. How you get it? The person can abuse the power because there's what? Too much power in his hands. 2, lack of involvement of the board. So a weak governance system may exhibit what? A lack of active participation and oversight from the board of directors. So this can result in ineffective decision-making, inadequate strategic or direction, and insufficient checks and balances. You have a lot of divisions, right? You're operating these divisions. Now, the board is never, though the divisions are autonomous, there's no checks and balances. That means the managers are doing what they want to do. Everybody is trying to what? Increase his own return on investment or return on capital employed and what? Residual income just because of some bonuses. Because there are no appropriate checks and balances, they are going to create their own wealth or they are going to increase their own personal what? Interest. You get the idea? So if the board is not involved or what? Top management is not involved in the particular decisions that you are taking, it can what? Influence people to what? Put in abysmal behavior. Not so. Now, sometimes there's lack of appropriate or adequate control function. Now, inadequate internal controls and risk management is also a problem most of the time. I get it, and it can be indicative of poor corporate governance. This can lead to increased risk of fraud, mismanagement, and non-compliance within organization because 1, you do not have proper controls and you do not have an internal control function. I get a lack of independent scrutiny. Okay, that's also another deficient aspect of corporate governance, a lot of corporate governance functions, not so. Now, a deficiency in independent oversight and scrutiny, such as what? The absence of independent directors or independent auditors can compromise the objectivity and integrity of the decision-making process because we cannot really see whether there's independence or somebody is doing the right thing because we don't have somebody who is checking what the other person is doing. I hope that is okay. Now, the next thing is the lack of contact with shareholders. Now, poor corporate governance may also involve a lack of transparency and communication with what? Shareholders. This can include limited access to relevant information, insufficient engagement in the voting process, and inadequate channels for shareholders to what? Express concerns or exercise their rights. Remember, the owners themselves, if you are not contacting them or frequently engaging them, then it may be a problem because you need to what? Engage the owners. And sometimes short-termism is also one of it. So when you identify these in cases, also know and talk about it, okay? So when a company prioritizes short-term financial gains over long-term sustainability and stakeholder interest, it may indicate a failure in considering broader aspects of corporate governance, such as responsible and ethical business practices. We also have misleading accounts and creative accounting and what information. Now, poor corporate governance can involve manipulation or misrepresentation of financial statements and other information, potentially misleading investors and stakeholders about the true financial health and performance of the company. Now, one thing that I have to tell my students is that when you are asked to do a SWOT analysis, okay, which means that you must look at your strengths, you must look at your weaknesses, you must look at what? Your opportunities and threats, right? Now, the thing is that the strengths and weaknesses are within the organization, also within. And corporate governance is also within the organization. So any symptoms of weak corporate governance is a weakness, right? When you are doing SWOT, actually students do not look at this side. When they are doing SWOT, they don't even look at corporate governance. They see corporate governance as something different. No, these things are within the organization. So if you are doing weaknesses and you see there's lack of investment, lack of involvement of the board, you have to write it as a weakness. If you see good corporate governance practices too, they are strengths because they can help boost the company's ability to achieve its objectives. So learn to blend. That's why I said when you are doing financial, learn to blend all these things. Good ethical practices, it's a strength. Weak ethical practices, it's a weakness. Even weak ethical practices can be a threat because other people fear to invest in your company because you are not what, ethical. I want you to have varying views when you are answering a case. You get the idea? So you don't just separate corporate governance as something on its own. So these are some of the things that when you get a case, your mind should tell you first that there may be something wrong. Okay, the chairman, if the chairman of the board and the CEO are the same person, then you see that what it is dominated by a single individual, or too much power is in one person's hand. Are you getting it? So addressing these symptoms of poor corporate governance requires implementing robust government practices, including the establishment of clear roles and responsibilities, independent oversight, transparent reporting, and active engagement with shareholders. It is crucial for companies to prioritize accountability, integrity, and ethical conduct to foster trust, ensure sustainability, and protect the interest of all stakeholders. Now, general principles of corporate governance, these are the same as the ones that we saw as the key pillars. You can use the same thing. So, ensure adherence and satisfaction of the strategic objectives of the firm, minimize risk, promote integrity, assign responsibility, establish clear accountability, maintain independence, accurate and timely reporting of relevant, reliable financial and independent financial and operational data, encourage proactive involvement of the owners or members. So those same integrity, accountability, independent assurance, responsibility, transparency, honesty, and integrity is the same thing here. Remember, I'm still talking about the same thing. The key pillars are the general principle. So by adhering to these principles of corporate governance, organizations can enhance the operational efficiency, mitigate risks, foster trust, and promote long-term sustainability and success. So we have to look at specific principles of corporate governance. We have looked at the general principles of integrity, independence, assurance, responsibility, accountability, fairness, equity, all that, right? But there are specific ones, and the common one that our syllabus actually requires is the OECD principles. Now, these OECD principles is a common feature of ICA exams. It pops up most of the time. So it has to be part of your toolkit. It has to be part of your toolkit. Now, in 2006, Ghana formally adopted the principles of corporate governance set forth by the OECD. By incorporating these principles, Ghana sought to improve its corporate governance practices and align them with international recognized standards. Okay. Now, the OECD principles and their focus on separation of ownership and management. The OECD principles of governance are designed to address the relationship between company owners, which are the shareholders, and the company managers, which are the board and the executives. One of the central themes of the principles is the separation of ownership and management, where shareholders' interests are protected and the boards and executives act in the best interest of the company. Now, there are principles, or the OECD principles, right? There are 5 broad principles, okay? Some people break the last one into 2, but they are just 5. The first one is the right of the shareholders. Now, the OECD principles emphasize that Shareholders should have the right to participate and vote at general meetings, elect and remove board members, and access relevant information about the company. So these rights empower shareholders to have a say in the company's affairs and hold management accountable. So the right of the shareholders is the first one. Two, the equitable treatment of shareholders. So first, they must have right. The second one is what? The importance of treating all shareholders equitably and fairly. This means that all shareholders, regardless of the size of their shares or their status, should be given equal treatment and have equal access to information and opportunities. The third is the role of stakeholders. The OECD principle recognizes that the importance of protecting the rights of stakeholders, which includes your employees, your customers, suppliers, the broader community, and all other stakeholders impacted by the company's operations. Stakeholders should have their interests taken into account and be involved in the decision-making processes of the company. Then we have disclosure and transparency, which is a key pillar of corporate governance also. These principles emphasize the need for companies to provide timely and accurate disclosure of relevant information to shareholders and stakeholders. Transparent reporting builds trust and enables stakeholders to make informed decisions. And you see, these OECD principles still house the principles that we talked about earlier. And we have the responsibility of the board. The board plays what? A critical role in the corporate governance. The principles stress that the board should provide what? Strategic guidance, effectively monitor management actions, and act in the best interest of the company and its shareholders. Effective board oversight ensures responsible management and alignment with shareholders' interests. So that is it. Also, the rights of the shareholders, equitable treatment of shareholders, role of shareholders, disclosure and transparency, and the responsibility of the board. Okay, so there are some code of best practices that listed companies should follow. Okay, so the code of best practice for listed companies in Ghana is a set of guidelines and responsibilities and recommendations also for corporate governance practices that publicly listed companies in Ghana can voluntarily adopt. It's not compulsory, but you can voluntarily adopt. It aims to enhance transparency, accountability, and responsible management among listed companies. Okay, so the code enshrines fundamental principles of corporate governance that are expected to be followed by organizations. So let's explore each of the 7 sections of the code. The first one is the mission, responsibilities, and accountability of the board. Now, this section outlines the role and responsibilities of the board of directors in providing strategic direction, overseeing management, and protecting the interests of shareholders and stakeholders. It emphasizes the importance of what? An effective board in ensuring what? Good corporate governance. Okay, so the role of the board and how accountable they are. The next is that the board should have committees. That's one of what? The key requirements. The code recommends that we should have key board committees like audit committee and remuneration committee. These committees play what? Crucial roles in providing oversight, ensuring financial reporting integrity, and setting executive remuneration that aligns with performance and shareholder interest. Also, you must have appropriate relationship with your shareholders and other what? Stakeholders. Now, this section emphasizes the significance of fostering healthy relationships with shareholders and other stakeholders. It includes guidelines on shareholder engagement, communication practices, and addressing the concerns of various stakeholders. So remember, these are all principles, the principles that we talked about that have been formed into what? A code of best practice. Also, financial affairs and auditing. It focuses on financial reporting and auditing practices. It emphasizes the importance of transparent and accurate financial reporting, compliance with accounting standards, and timely disclosure of financial information. Also, we have disclosure in the annual reports. The code encourages companies to provide comprehensive and relevant information in their annual reports. Okay, so this includes disclosing annual financial performance, your governance practices, risk management, and other material information that aid shareholders and stakeholders in making informed decisions. Okay, so when it comes to these ones, okay, you have to look at the roles, responsibilities, the accountability of the board. The board should have appropriate committees. You should have a proper or appropriate relationship with shareholders and your stakeholders. You should audit your accounts. You should have appropriate disclosure in the reports. And also, you should what? Adopt a code of ethics. I get it, which sets out your ethical standards and conduct of directors, executives, and employees. A strong code of ethics helps instill a culture of integrity and responsible behavior within the organization. Okay, and it has a glossary which provides definitions and explanation of key terms and concepts used in the combined code. Okay, so it ensures clarity and a common understanding of the code's provisions among listed companies and stakeholders. It is important to note that the code of best practice for listed companies in Ghana is not mandatory. However, it serves as what? A valuable reference and benchmark for companies seeking to adopt robust corporate governance practices. So by voluntarily adhering to the code, listed companies can strengthen their governance structures, enhancing their reputation, and to gain the confidence of investors and other stakeholders. Now, you realize that I am sort of speeding up, yes, because I want us to get to the point where we can apply these principles. These are theories which you can read anywhere. And this one's code of best practices, they are already in the principles we discussed earlier. That's why I'm speeding up here. Do you understand? Because there are some things that you can write. We all know that you should have appropriate relationship with your shareholders. We should have disclosures. We should have a code of ethics. We should have committees on the board. We should have what? Appropriate roles for the board. So if I'm speeding up here, I think you should understand, because these are the things that we've already discussed at the top before we got here. You understand? So I want us to finish up and then start looking at the case. That's why I'm sort of what? Looking at that part. Now, let's look at some critical areas of corporate governance. These areas play a crucial role in ensuring effective governance, transparency, and accountability within organizations. So let's look at these areas in more detail. So when it comes to corporate governance, these are critical areas. Now, these critical areas are also best practices. That's what I'm saying. You see, it depends. This one, there's no one way of answering corporate governance question. So far as the things you are saying is in line with things that will bring sustainability and what appropriate governance, you'll be marked. For instance, these critical areas include the role and responsibility of the board. And you remember we saw this when we were looking at the code of best practice. It's there. Composition and balance of the board of directors. Okay, this is one critical area. So the composition of the board is essential to ensure its effectiveness and independence. Now, corporate governance codes stress the importance of having a diverse and balanced board comprising directors with relevant skills, knowledge, experience, and independence. An independent board is more likely to provide unbiased oversight and make objective decisions, right? That is why we have to have a balance of skills and resources on the board of directors. Now we have financial reporting, sustainability reporting, and auditing, okay? Now, accurate and transparent financial reporting is fundamental for corporate governance. Corporate governance codes emphasize the importance of providing clear, reliable, and timely financial information to stakeholders. Additionally, sustainability reporting has gained prominence, and companies are encouraged to disclose their environmental, social, and governance performance. Now, there's a need now, even as at now, not so, that every company is supposed to report what his social and environmental aspects of his performance. Okay, so triple bottom line. Now, performance is from three phases: your social aspect, how you relate to people, you treat your staff and other stakeholders. Also, you have the environmental side, also, which is how you treat or your operations impact the environment. Then we have the economic side, which is what we know are actual profits that we make. Also, now, how do these things all relate or what fits into each other? That's what we call sustainability reporting. It comes with TBL, triple bottom line. Okay, so which is C. social, environmental, and what economic aspect of reporting. Are we okay? Then the next another critical area of corporate governance is directors' remuneration or directors' compensation. Now, corporate governance codes address the issue of executive remuneration to ensure that it is aligned with the company's performance, shareholder interest, and industry standards. Now, codes often recommend the establishment of remuneration committees to set appropriate and fair compensation for executives. Is that okay? Now, another critical area is what? Risk management and internal controls. Now, corporate governance places a significant emphasis on risk management and internal control systems. Companies are therefore encouraged to identify one and manage risks effectively. So when we get to risk management, you will understand risks better, the kind of risks that companies face, how they manage the risk, who is a risk manager, what is his roles, what is the role of the board in risk management. So it's a key area of corporate governance. Are we okay? Why do we do this? We want to do that to what? Assess our risk exposure to safeguard our assets and reputation, because the more risky you are, the more you can collapse your business. Now, shareholders' rights are also one of the key areas of our corporate governance. Respecting and protecting your shareholders' rights is also what? A critical aspect of corporate governance. Codes highlight the importance of providing shareholders with sufficient information, ensuring their participation in decision-making, like the ability to vote, and enabling their success. I get it by giving them access to what? Company records and meetings. So the shareholder will see himself that, okay, what I want, I've been given. Not so. Then also disclosures, a key area of or critical area of what? Corporate governance. Because of the key principle of what? Transparency. You remember we talked about transparency. It is a cornerstone of corporate governance. Now, companies are expected to disclose material information promptly and accurately to shareholders and their stakeholders. Now, comprehensive disclosures help you to build trust with those people, foster accountability, and support well-informed decision making. Now, corporate social responsibility and ethical behavior. That is also one key principle, right? Now, corporate governance codes increasingly stress the importance of ethical behavior and corporate social responsibility. Companies are therefore encouraged to act responsibly, engage with stakeholders, address environmental and social concerns, remember triple bottom line, and contribute positively to the communities in which they operate. Okay, so when we address these critical areas, organizations can therefore enhance their governance practices, build stakeholder trust, attract investment, and achieve sustainable long-term success. Corporate governance codes serve as what? A guiding framework to support companies in adopting responsible and ethical behavior while promoting transparency and accountability through their operations. Okay. So the next issue is stakeholders in corporate governance. As you can see, corporate governance has a lot of theory. It has a lot of theory, but my issue is that the theory, anybody at all can know the theory. The thing is, how do you apply it to a scenario? That is what I am concerned about. So you see, everything is about best practice, best practice, best practice. Yes, because in a question, you may be tempted to look for the best practice in there, whether the people are actually engaging or they are actually what? Applying the best practice. Okay, so the key stakeholders in corporate governance includes the board of directors, the chairman, the CEO, the committees of the board, the shareholders, the directors, internal audit, external audit, your employees, your customers, your suppliers and business partners, your communities and society. Ask me why I'm running through this. You know who stakeholders are, and you know all the stakeholders who are interested in the business operations, their expectations, and how to manage them. Now, I would unmute you, and then you tell me, when I mention the stakeholder, you tell me his level of power, his level of interest, and how to manage him. We are going to use two matrices. You tell me where they will fall. So first, we are going to use the importance and position matrix. We are going to draw the matrix together. Then you tell me where each of them fall. So please, let's label them. Where would they fall? Here, if here is importance, importance starts with what? -5 to +5, right? Then opposition, or what we call what? Position also. Whether they oppose to importance low, high. Whether they oppose or whether they support the current strategies of the business, right? This is also what? +5, support, and -5. What are these people known as? Yes, you can unmute and talk. What are they known as?
Problematic.
They are problematic, okay?
Yes.
How to satisfy them? What's the strategy? I've written it. What did I write? You win their support. Now, what about these people? Who are they?
Antagonistic.
Antagonistic stakeholders. How do we manage?
Antagonistic.
How do we manage them?
You compromise.
Find a
Compromise.
okay. Then these people, low priority also. How do we deal with them? We put in minimal effort, right? At least communicate with them also. What about these ones? Supporters also.
Yeah.
Supporters, what do? We maintain good.
Goodwill.
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 What's for motivations?
Okay. Somebody said something.
I said goodwill and small motivations.
Yeah. So let's take the board of directors, the chairman and the CEO. Where would they fall? Here, where would they fall? It actually depends. So you have to look at their nature or their position, actually, right? So when it comes to the board, if the board is a supporting one to the operations of the company, then you could say that they are supporting, true or false? You could say they are what, supporters, true or false? So we must maintain the goodwill.
True.
What about a stubborn shareholder?
Antagonistic.
Antagonistic.
Antagonistic. Why? Because one, he has a high opposition also. He has a high opposition, which is what? -5, and has what?
High importance.
High importance, right? Which is also what? +5. So this guy, what do we do to him? We try to find a compromise with him. Not so? What about a key supplier who is sort of what? Giving us high prices. He keeps increasing prices. Yes, how do we manage this supplier? If he's increasing prices, would it be in line with our goals? Is he opposing us or is supporting us?
He's opposing you.
He's opposing. And because he buys majority of our raw materials, where will we put him on this matrix?
Problematic.
Key supplier.
Antagonistic.
No, antagonistic.
He's very important. If he
Antagonistic.
if he says he won't supply us goods, again, we will lose business, right? Meaning it's very important. I get it. And he's opposing because he's a monopolist, right? He literally controls everything we have. That makes him antagonistic. What about a key customer? A key customer also be antagonistic, right? Because he buys almost all of our goods, and it's very important because if he goes out, the business will collapse. I hope you are seeing how I apply these models. Is it becoming clearer?
If you decided to buy from us, then he's supporting us too.
Yes. Yes. If he decides to keep buying from us, then he's not opposing, right? He's supporting us because he's going to increase our revenue. What if that customer keeps asking for discount? Is he supporting or opposing?
Opposing.
Opposing because it keeps what? Bringing down our profit. So anything that brings you down is literally opposing, right? And anything that increases your position is literally what? supportive. I hope you are gradually getting the matrix. Now, when it comes to the answer, some people put the stakeholders in the matrix like this. Yes, when you put it here, when you are writing, you still have to write them. Okay, this is just to showcase the diagram, but you still have to write them. A lot of you did not write them. You are still supposed to write them after talking about antagonistic. Then you say the following stakeholders appear to have the antagonistic position in the matrix. Then you list them there. 1, 2, 3, 4. Then you tell us that this is how you manage these stakeholders. But you just wrote this and you say this is how we manage them. What if the person didn't look at your diagram? You get it? So please, I beg you, when you are doing this, you make sure that you are able to deal with them. So this is the first part of corporate governance before we now dive into the role of shareholders, the role of the board, the composition of the board, and other things. Any questions before we proceed? Any question before we proceed? Yes? Any question before we proceed?
Prof.
Yes, boss.
I was asking myself, those theories, or are they in ICA book?
Yes, they are there. It's actually from your ICA book. You are supposed to know all of them. But one thing you must be happy is that when you look at it, you realize that they are all similar. True or false? Tell me the truth. Are they not all similar?
They are similar.
They are all similar. So you just have to have an idea. When we talk about best practice, if they say principles, somebody may go with the OECD, somebody may go with integrity, honesty, accountability. And you saw that those same things, equity, right? You have to treat your shareholders fairly. Remember, it was part of the OECD principles, true or false? So they are all similar. Are you getting it? When we talk, it's only some few ones that you have to actually know, like the stakeholder theory, right? The corporate governance theories. So let me ask a question, a little quiz before we continue. Now it's time to test what we have learned so far, right? So let me ask you, the first question is, what is the stewardship theory? Or explain the stewardship theory to me. Yes, I'm listening. Stewardship theory. Stewardship theory.
Okay, so Prof.
Yes, boss.
The stewardship theory is one that attempts to treat stakeholders as stewards who have an intrinsic motivation to keep the company's interest at heart.
Okay. And who are those stakeholders in particular?
In particular, they are likely to be managers, employees, people that are directly related to the daily functioning of the institution or the organization.
So particularly, we are talking about the managers as stewards. Do you get it? Or the directors as stewards. Do you get the idea? So they have the assets of the company, and then the owners have given the assets to these people to manage it. They can manage it to enhance and protect our value when they have motivation. If not, they still create their own wealth. Is that okay? Now, the next question I'm going to ask is that there's two approaches to managing corporate governance, which is the rules-based approach and the principle-based approach. I want somebody to distinguish between the two for me before we proceed. Rules-based approach and principle-based approach to corporate governance. Yes, I need a lady. The men have talked. I need a lady. Rules-based approach and principle-based approach to corporate governance. Yes, we have less time. Corporate governance is very broad. So, yes. Nobody will talk. We explained this in detail, right? Yes. How much will meet you? The ladies. I said I need a lady. The ladies are quiet. Rules-based approach to corporate governance and principle-based approach. differentiate between the two. Okay, the guys, it seems no lady wants to talk. Yes,
Well,
yes, boss.
with respect to the rule
The
based
rules basis.
it
Okay.
provides a specific instruction and requirement that company must comply with in their governance practices.
Okay.
Whilst the principle-based corporate governance focuses on guiding principles
Okay.
of an organization.
Okay.
So whilst this one, the rule-based corporate governance is more of regulatory, while this one is more of principles.
Okay.
The principle-based corporate governance is more of guiding principles.
Discretion.
Okay. So what are some of
Hello,
the
Prof.
yes, boss?
Oh, sorry. Then I think that's what the characteristics, or that's what I was going to
Yeah.
say.
So give it to me. I'm listening. What are some of the characteristics?
So I think that the rules based are in themselves punitive in nature,
Okay.
but the principle based, and yeah, I think so.
I didn't hear you.
Hello, Prof.
Yes, boss.
I was saying that the rules based are punitive, like they carry penal actions
Okay.
as against the principle based ones, where it is expected that the companies will apply with a certain laid down corporate governance principles.
That's true. And what are some of the advantages and disadvantages of each of those ones, both the rules-based and the principle-based? Yes.
The advantage of the rule base is that
the rule base is usually rigid.
Okay, it's written. That's one. Two.
That's a disadvantage.
Disadvantage.
Okay. Then advantage.
And the principle base is flexible.
Flexible. Okay. So one is original, one is China. Eh? Okay, so what else can we talk about? Is that all we learned?
For Prof.
Yes, boss.
Prof, for the rule based.
Please, I'm listening. Oh, it's like your network. Okay, so I think that part everybody understands now. Now, my next question is, give me 5 symptoms of poor corporate governance. 5 symptoms of poor corporate governance. Please, the ladies, we want to hear your voice, Sam. This time, please, I beg. A lady should just say it. You heard it. You all heard me. Yes. Symptoms of poor corporate governance. Yes, the ladies. Symptoms of poor governance. You have to move. Oh, it's 8. Symptoms of poor governance. What will we see in a case that will tell us that this company has poor governance? Yes.
Hello.
I want
Hello, Prof.
to speak, but no problem.
Ladies. So usually, because they are most of the time they are like family-owned businesses, that because of that, there's usually a domination of a single individual, or let's say a few number of people, maybe 2-3 people, managing the entire affairs of the organization.
Okay.
And then that will also result in power and a lack of maybe accountability or something like that.
Okay. Is that all?
Also, Prof, another symptom of poor corporate governance is lack of involvement of the board.
Okay.
If the board is not involved in the activities of the organization, it's a red flag.
Okay.
Signifying poor corporate governance.
Okay, is that all? There were a lot. There were a lot. Yes.
Can you also talk something about unbalanced composition of the board?
Nice.
That's where you have
For
more
instance, too many
executive directors than
independent.
non-executive
Yes, of course.
directors. Yes.
Very good point. Yes.
And then
Yes.
focus on optimism, like in terms of profitability. When people want to look at what they will gain now as to the larger interest of the corporate entity itself.
That is true. That is true. Okay. Most questions, you see that they haven't separated the roles of the CEO and the chairman. They are one person, right? Meaning unfettered power in the hands of one person or domination for a single individual. When we have inappropriate controls, when we do not have appropriate committees on the board, right? If you want to look at the weaknesses, you can turn the best practices upside down. You can turn it the other way and you get weaknesses. For instance, lack of involvement with shareholders. Are you getting it? Not treating stakeholders equitably. Is it not a weakness? So the best practice, you can turn it the other way around.
Right.
Point. Not having transparency or not being transparent or lack of transparency on the board. Is there not a point? So I took transparency and turned it upside down. Lack of ethical behavior of directors. I've taken it and turned it upside down. That's why I'm telling you that up to the point
Lack of integrity.
of integrity. So what I was saying is that these things, you can turn them and, rewrite them in some ways that will still give you point. That lack of integrity, you can even open it up. That where directors seek to increase their own wealth, not to be associated with misleading information or not being straightforward. You see, you've used integrity to create a whole point. Do you get it? It's exam technique. So don't learn so many things, but the little you have, learn to make use of that. Do you get the idea? And you can, these things, they are all similar. They are all having similarities, right? Are we all okay? Are we all okay? So can we go to the role of
Yes.
the board and the role of the board, and then we close the chapter on corporate governance and start looking at cases? Do you think we can proceed? Can we proceed now?
Yes, we can.
Okay. So give me some 2 minutes. Let me get some water and then I'll get back to you. Okay. So let's look at the role of shareholders in corporate governance. Now, the first thing we have to look at is the active involvement of shareholders, which we call shareholder activism. Now, this refers to the active involvement of shareholders in the affairs of the company and its management. Now, shareholders have to use their ownership rights to influence the company's decisions, policies, and corporate governance practices. Now, activist shareholders may engage in various activities, such as proposing shareholder resolutions, voting on issues in the board, and engaging in dialogue with management and the board of directors. The next role is shareholder composition. Now, remember, shareholders are individuals, entities, or institutions that own a portion of the company or own shares in the company. They can be individual private investors, retail investors, or larger institutions like mutual funds, pension funds, insurance companies, and private equity firms. And these ones, we call them institutional investors, right? They've collected money from a lot of people and they're investing. So these people, they can worry. I get it. That is even one of the key drivers of what corporate governance, you remember. So in recent years, institutional shareholders have been increasing their holdings in companies, and their combined ownership can have a significant influence on corporate decisions. Okay, so remember, the composition of your shareholders demands or actually what takes the particular role they are going to play. You get it? Then we have a power balance shift. As institutional shareholders amass larger stakes in companies, they gain more influence over corporate decision making. So the shift in the balance of power has increased shareholder what? Activism, which is how active they are, and also on the board, as institutional investors are legally obliged to actively manage investment on behalf of their clients, often seeking to maximize shareholder value and improve governance practices. Those people, imagine you've given your money to SNIT. SNIT has invested in a company, right? You're expecting that when you go on pension, the money will come. And it doesn't come. What will happen? Okay, and yes, sir. Yes, that is why SNIT as a shareholder will also not slow down, right? He will make sure that the governance policies are being put in place correctly. Then we have what? Board shareholder communication. We know that communication is crucial for maintaining transparency, accountability, and trust. Because of that, one of the roles of the shareholder is to what? Communicate with the board. Then we have shareholder voting. Shareholders must be able to exercise their voting rights to elect directors, approve executive plans, vote on important corporate matters, and even take directors off the board. We have shareholder resolutions. Proposing resolutions for consideration at the meetings are one of the rules of the shareholder. Then we have proxy voting, right? And here, institutional shareholders can vote on behalf of their clients through proxy voting. So for instance, in actual sense, if let's say, I usually use SNIT as an example because a lot of people have investment in SNIT, right? As a worker. Now, if SNIT is voting, automatically SNIT is voting on your behalf as a shareholder in the companies where they invest. Indirectly, you're also a shareholder. So they act as proxies on your behalf. Are you getting it? Those are some of the rules of the shareholder. Now, we have to now look at our big bosses and the people there, the board. We have been saying the board. Who are the board, right? Before we look at who the board is, what is on the board, there are two types of board structures that are maintained in the world. We have two main types. We have what we call a unitary board and a two-tier board, okay? So the common ones we operate in Ghana here are unitary boards. Unitary boards are single boards, okay? So there's a single board that consists of executive directors who are involved in the day-to-day operations and non-executive directors who are independent members with expertise and experience who are not necessarily working in the company, right? So this board is commonly found in most organizations. Even in Ghana here, we mostly operate unitary board, right? One board of directors for an organization. Okay, the two-tier board, we'll come and look at it later, where like Germany and other countries, there are two-tier boards or dual boards. Dual board means that there are two boards. The supervisory board, which oversees the management board. So the management board is made up of executives who run the day-to-day operations and all that, right? And the supervisory board is the one which oversees what the management board is doing, which are mostly made up of only NEDs. I get it. So it's like that. But here we bring all of them together in one and call it a unitary board. Okay, so why unitary boards? What are the advantages? One, it creates a streamlined decision making. That means it enables faster and more agile, responsive approach to decision making, also in addressing business challenges and opportunities, because it's just one group of people. Now, unified governance. With a unitary approach to governance, unitary boards provide what? A unified governance structure where all directors collectively oversee the management and conduct of the business. This promotes a sense of shared responsibility and accountability. 3, efficient communication. With a single board, communication and information flow within the organization can be more efficient. This allows for better coordination, alignment, and sharing of insights among the directors, resulting in more effective governance. And it fosters good relationship, right? Because we are all under one umbrella. It can bring varying ideas and varying what? Sense of what? Belonging. It creates a sense of belonging as well, because all of us are under one umbrella. It creates clear accountability. I get it for both strategic decisions and operational outcomes, because all directors collectively bear responsibility for the organization's performance, both directors, both the executives and non-executives. It brings ease of coordination, because board activities can be coordinated, meetings, decision-making processes in a similar and simpler way, right? Which reduces the need for separate board meetings and facilitates regular interaction. It even saves the resources by not duplicating resources for dual boards. Are you okay? The problem is that sometimes it may lead to lack of independence. Maybe the independent director you are seeing as a non-executive may be the other director's friend. Not so, because they are on the same board, they bring their own people on board. And sometimes it can bring so much workload, because one board is doing everything, okay, which can bring so much workload than when it was two separate boards. Are we okay? So that is what we call unitary boards. When they come, you should be able to talk about a single board structure or a dual board structure. Now we are going to look at dual boards. Other people know them as two-tier boards, okay? So in a dual board structure, there are separate boards for the executive and non-executive directors. The executive board focuses on the day-to-day management, which I explained earlier, while the non-executive board provides oversight and guidance. So this structure is less common and often found in certain countries or specific types of organizations. It is often known as a two-tier board. So that's what I explained. So with this one, how the structure looks like is this. So when you look at the board, we mostly have the supervisory or the oversight board, right? So the supervisory board will be at the top here, and they will be monitoring the what? The management board. Okay. They will be monitoring the management board, and the management board will there have the CEO at the top, or the managing director. Also, then the various heads. So finance, marketing, production, IT, R&D, I get all the functional heads will be under them. Are you okay? So this is how the two-tier board works. Now, with a two-tier board, it also has its advantages and disadvantages. Are we okay? So you must know all of them. Now, with this one, there's clear separation of roles, because the dual board provides a clear separation of roles between executive and non-executive directors. This allows non-executive directors to focus on oversight, governance, and strategic decision-making without being involved in the day-to-day. So it brings clear rules. They are not engaged in the day-to-day. Yes, it's just governance, right? Then it brings enhanced independence, because there are only NEDs there at the top level or the supervisory board. I get to know, and it helps what bring independence. Because of that, it can bring diverse perspectives and expertise to the board, providing objective oversight and reducing potential conflicts of interest. Also, it brings about strong governance practices. So with separate boards, there is a greater emphasis on governance practices and accountability. Non-executive directors can devote more time to governance matters, ensuring effective oversight, risk management, and adherence to ethical standards. Then we have what? Greater board diversity. Now, dual boards often promote diversity in terms of skills, experience, and backgrounds among non-executive directors. This diversity can lead to a more robust decision-making and a broader range of perspectives, enhancing board effectiveness. Are we okay? Because there'll be so much skills and experience on the board. Then investor confidence. Some investors may view the presence of a dual board as a positive factor in terms of corporate governance. The independent oversight provided by non-executive directors can enhance what? Transparency, accountability, and ultimately investor confidence, because he knows that now the executives cannot compromise the non-executive. You can't bring your friend because he's appointed by someone else. Are we okay? So the disadvantage is that sometimes there may be communication challenges between the two boards, because Sometimes because of information flow may be difficult to coordinate. There may be inefficiencies and misaligned strategies. There may be potential conflict, right, between the executive and the non-executive boards. Differences in objectives, differences in priorities or perspectives can hinder effective decisions because they are not lining up. Right? There may be increased complexity because maintaining separate boards adds an additional layer of complexity to the governance structure. It may require more resources, more time, more coordination to ensure smooth functioning and effective communication between the two boards. Also, there may be limited integration. So the dual boards may struggle with integrating perspectives and insight of non-executives into the day-to-day operations because they may lack local knowledge, right, about what is actually going on down there. And sometimes the availability of qualified directors to fit particular positions may be a problem. I get in it. And therefore, it may limit the pool of potential candidates and impact the overall effectiveness of the dual board structure. So be ready to discuss unitary and two-tier or dual board. So let's look at the board of directors themselves. Now, every company is led by a board of directors, which is collectively responsible for achieving the objectives and long-term success of the company. The board should have appropriate size, knowledge, skills, and experience, and they should be independent. So what are the types of directors on the board? So we have three that we mostly look at, and it is actually two, but out of the two, the non-executives are expected to also be independent. So let's just say three. Are we okay? Now, the first type is executive directors, who are individuals who hold executive positions within the company. They are typically involved in the day-to-day operations of the organization and are responsible for managing and implementing the company strategies. So executive directors may include the CEO, that's the chief executive officer, the CFO, chief financial officer, the CEO, chief operating officer, and other executives, and also who hold senior management positions. Okay, that's why they are called executives. They engage in the day-to-day operations. Then we have the non-executives, who are board members who do not have an executive role within the company, but they provide independent and external perspective where bring different views on board in the decision-making process. So NEDs they bring diverse skills, expertise, and experience from different industries or sectors. We can contribute to better governance and strategic oversight. So they offer independent judgment and challenge the executive directors, ensuring a balanced decision-making process. Are we okay? Those are the NEDs. Now, independent directors are actually subsets of each director. Each director can be independent, but executive directors cannot be independent, mostly non-executive. So we want every non-executive to actually be independent, at least. Independent directors are a subset of non-executives who meet specific criteria of independence. These criteria may vary based on corporate governance regulations or guidelines in different jurisdictions. Independent directors are considered impartial and free from any conflict of interest that could compromise their objectivity. They provide an additional layer of oversight and serve as a check on management decisions. Now, independent directors are expected to act in the best interest of the company and its shareholders. Are we okay? So it is important for what? Boards to have a mix of executive and non-executive directors, including independent directors, to ensure a diverse range of perspectives and effective governance. The presence of independent directors also helps maintain transparency, accountability, and responsible decision-making by providing an unbiased assessment of the company's affairs. So we have to look at the typical structure of the board. The structure of the board is actually a critical aspect of corporate governance, and it can vary depending on the organization's size, type, and legal requirements. So let's explore the typical structure of a unitary board, a common board, right? Now, the chairman. We have the chairman at the top of the board, who is a non-executive director who leads all the board's activities. They are responsible for ensuring that the board functions effectively, that appropriate governance practices are followed, and that board meetings are conducted efficiently. So the chairman may also act as a bridge between the board and management, right? Because he's in charge of the board. He chairs the board. Then from there, we have the CEO, the chief executive, right? He's the head of all the executives. Now, the CEO is a typical senior executive director, who is what responsible for day-to-day operations of the company. So he carries the operational decisions and everything to the board, right? And implementing the strategic decisions made by the board. Now the CEO is what accountable to the board for the what the company's performance and regularly reports to the board on the company's progress, on how operations are going, right? Now, the other directors. The board may consist of other directors, both executive and non-executive. The other directors, executive directors, are typically part of the management team, like the chief operating officer, chief financial officer, and may hold key operational roles. Non-executive directors are independent individuals who provide an external perspective and objective oversight of management decisions. They bring diverse expertise, experience, and independence to the board of directors. Then we have the secretary to the board. Now, the secretary is a senior executive who acts as an advisor to the chairman and the board on governance matters. Okay, usually secretaries are lawyers most of the time because they are going to be advising on the corporate code and other things, right? They ensure that the board procedures are followed, provide guidance on what governance best practices, and manage board communications and documentation. The secretary is often what a qualified company secretary with expertise in legal and governance matters, as I was telling you. So it is essential to know that the board's composition can vary depending on local regulations, industry practices, and the specific needs of the company. In some cases, the chairman and the CEO roles may be separate, with the chairman being an independent non-executive director. Separating these roles is often seen as governance best practice to ensure a clear division of powers and responsibility. So most questions that you are going to see are all around these areas. I will not lie to you. After that, we'll look at some sample questions. Additionally, larger companies or companies with complex operations may have more extensive boards with a mixture of executive and non-executive directors, including independent directors with diverse backgrounds and expertise. The effectiveness of the board depends on its structure, how diverse it is, independence, and commitment to fulfilling its fiduciary duties to shareholders and other stakeholders. So an effective board is essential for ensuring the long-term success and sustainable growth of the company. Now, let's look at board size. So the size of the board is a crucial aspect of corporate governance that can significantly impact board effectiveness and decision-making. Now, different jurisdictions and corporate governance codes may provide guidance on the board size, but the optimal size can vary depending on the company structure, complexity, and specific needs, and even the country of operation. For instance, in Ghana, we have our own size of a typical board, right? Here are some consideration regarding board size and director appointment. So when it comes to board size, we look at a size that can promote effectiveness. So a board should have a sufficient number of directors to enable effective decision-making, oversight, and strategic planning. So a board that is too small may lack the necessary expertise and diversity, while a board that is too large too can lead to inefficiencies and difficulty in reaching consensus because the people are too many. Secondly, ensuring appropriate representation. The board should have a balance of skills, experiences, and perspectives to represent the interests of various stakeholders, including shareholders, employees, customers, and communities. Are we okay? Now, the whole thing is that if we have a mixture of skills and experiences, it brings different perspectives on how to deal with issues on the board. Then we have board diversity. Diversity on the board, including gender, ethnicity, age, and professional background, can enhance the board to be effective by bringing a wide range of insights and reducing the risk of groupthink. I get in where people may be stuck as to what to do. Now, what is the recommended board size? Now, according to Ghana, our code of best practice suggests that an ideal board size is typically between 8 and 16 directors. I get it, each with different experiences in different industries, so on and so forth. I get it. So this range allows for a sufficient number of directors to fulfill their responsibilities effectively while maintaining manageable group dynamics. Are we okay? So let's look at appointment to the board. Now, the first one we look at is transparent and informed appointment. Directors should be appointed through a transparent and informed process. So when shareholders have access to full information about the prospective director's qualifications, their skills, and potential conflict of interest, are you getting it? then they can appoint him. So that's a transparent and informed appointment. So you talk to them, you talk to the shareholders about the potential director, they will assess everything about him, then they'll say, okay, let's bring it on board. Another way to appoint them is director re-election. To ensure accountability and board refreshment, directors should have the right of re-election at regular intervals. So when we re-elect you, it could be one of the ways of appointing you onto the board of directors. So in many jurisdictions, directors are subject to re-election at least every 3 years. Then we have independence and competence. Sometimes appointment process should prioritize director independence and their competence to ensure that the person they are bringing on board can exercise objective judgment and provide valuable contributions to the board discussions, right? You can't just bring anybody at all, but somebody who is valuable. Then board evaluation should also be considered, right? When we want to appoint somebody to the board. So regular board evaluation can help assess the board's their composition, the performance and effectiveness, so that we can identify areas for what improvement and potential skill gaps, so that we bring in people, not so, to fill those skill gaps, right? So remember, they can ask you, ICA, they are very smart. They'll give you a scenario and tell you that they want to bring a director on board. What are the key things that you have to consider before what bringing somebody on board? So what are the key things that you have to what consider? So sometimes you can use a mnemonic, right? TBIT. Okay. You can use TBIT or BT. It depends. TBIT. Okay. So TBIT. Transparency and informed appointment. You have what? Board evaluation, director reappointment, and what? Independence and competence. So TBIT. Factors to consider before what? Appointing somebody to the board. Okay. Very good point. Now, let's look at the duties of the board. Another key area for ICA exam. See, case study is a lot you have to learn. Now, first of all, the board should provide strategic guidance. The board is responsible for providing strategic direction and guidance to the organization. So it sets the corporate objectives, approves major decisions, and ensures alignment with the organization's mission and vision. 2, they should provide oversight of management, looking at management, checking what management is doing. Now, the board oversees the management and conduct of the business. It monitors the performance of senior executives, approves key policies and decisions, and ensures that the organization operates in compliance with laws, regulations, and ethical standards. So whatever you are doing, I check you. And this is one of the rules to check what? The agency theory. Are we okay? Now, 3, risk identification and management. The board should identify and evaluate risks that the organization is facing. That is why they are supposed to know where they are now and where they want to go, to know particular areas of risk and how to deal with them. Not so establishing systems, which is internal controls to manage and mitigate those risks. It ensures that effective risk management practices are in place and regularly reviewed. We also have succession planning and senior management. Not so. Now, the board is also responsible for succession planning, which involves identifying and developing potential leaders within the organization when the older ones are getting old, right? We have to look at how to replace them. It also oversees the appointment, training, remuneration, and replacement of senior management, ensuring competent and capable leadership. Also, they have to be able to set appropriate internal control systems, maintain them to safeguard the organization's assets, prevent control fraud, and ensure accuracy and reliability of financial reporting. Now, every organization must have controls, right, to prevent control risks. Okay, so every organization should institute some elements, right, put proper controls and ensure these elements are in place. So when you see internal controls, we look at crime, right? These are the elements of internal controls. We have the control environment, or let me just put here, control activities. Okay, some activities that you have to put in place. When cash is left, is it banked? Is it stored in a vault? Not so. Are there proper authorizations? Are documents signed before they are sent? Not so. Are there approvals? Because all these things are control activities. Do you safeguard your assets? Do you put passwords on your computers? You have risk assessment procedures. How often do you assess your organization for risk? Also, we have information systems. Your information systems say a lot about you. Appropriate information systems and how information moves may tell you how risks are controlled within the organization. So we have monitoring. How often do you monitor internal controls? Also, do you have an appropriate internal control function? We have the environment of controls or the control environment, which I put there E, right? Crime. Now, the environment of controls tells us management attitude towards controls. How do the board care about controls? If somebody tries to override a control, do you punish the person? How seriously or how strictly do you take your controls, right? These are the things that you need to consider. So as part of the board's job, they have to ensure that these things are in place so that people cannot easily override or bypass controls or collude. I get it, to bypass controls. Also, information communication and information dissemination, okay? Giving information and appropriate communication with shareholders and stakeholders too. Now, the board is responsible for establishing and maintaining effective communication channels within the organization and with external stakeholders. It ensures that relevant information is communicated accurately and transparently. So overall, the board has a fiduciary duty to act in the best interest of the organization and its stakeholders. So let's look at the balance of the board. There should be balance on the board, right? The board size should be appropriate. The board should have the right amount of knowledge, skills, and experience. There should be a balance between the executive and non-executive. At least 1/3 of the board, at least 1/3 of the board should be non-executives. Are we okay? At least 1/3. At least 1/3 should be non-executive. Don't forget this. Any one person should not be able to dominate the board, and there should be a split between the role of the CEO and the chairman, right? Because most of them, some boards, they are the same. And the question will ask you why there should be a split in the role of these two persons, right? Now, when it comes to the balance of the board, we have talked about it. Appropriate size, right amount of knowledge, skills, and experience, balance between executives and non-executives, at least 1/3, right? No domination. We should split the role of CEO and chairman, and we should have diverse knowledge, skills, experience, age, race, and also no discrimination. We look at all that. Then we come to board meetings. When it comes to board meetings, also, it should be held regularly, and there should be a minimum quorum present, and the agenda should be decided by the chairman. It should include both short-term and long-term issues. It should be circulated in advance so that all directors can prepare, and the chairman should direct the meetings and encourage debates on all board meetings. Okay, now, apart from these issues, there are particular issues that we have to understand, okay? So when we are talking about directors, they have some ethical rules they have to keep in mind, okay? These ethical rules, sometimes I use sister party, okay? So these ones you can use FATI to remember. Fairness, accountability, transparency, integrity, okay? Which mostly you can replace it with responsibility, okay? So the first one is responsibility. So with that one, the I here is integrity. It can still be given to you because they still have to consider integrity. Now, board members and executive, please remember, these are the ethical values that the board has to have. IC has specifically stated it in their syllabus. It's in the syllabus. So every heading that I've looked at is directly stated in your syllabus. Okay, I'm only looking at things that your syllabus directly stated. Are we okay? So the first is responsibility. Board members and executive management have the responsibility to act in the best interest of the organization and its stakeholders. So that's the first ethical value. They should make decisions that consider the long-term sustainability and welfare of the company. 2, accountability. The board members and executive management are to be accountable also for their actions and decisions. They should be answerable to the shareholders, employees, customers, and other stakeholders for outcomes and impact of their decisions. Okay? Then we have fairness. Ethical boards and executive management should ensure fairness in their actions and decisions. This involves treating all stakeholders with fairness and equity, avoiding conflict of interest, and upholding principles of justice and equality. Okay? So that is what you need to look at. So responsibility. So even I think this one is better than the FATI. You can even use RAFT, right? A RAFT. Responsibility, accountability, fairness, transparency. With this one, you can use RAFT. Okay. In older books, you see FATI. Now, transparency. Board members and executive management should operate with transparency, providing clear and accurate information towards stakeholders. This includes disclosing relevant financial and non-financial information, communicating openly about what strategies and performance, and maintaining transparency in decision-making processes, right? So transparency fosters trust, integrity, and accountability within the organization, okay? So all directors should have some 4 ethical values which they add to their toolkit, right? So RAPT, responsibility. Remember RAPT, responsibility, accountability. They should be accountable. They should be fair. Not so. And then they should be transparent. Please, I hope we are not going to forget this one. The 4 ethical rules of the board of directors. Then the next thing is that, you see, directors must also have, apart from the normal ethical behaviors, they must also have their moral duties or some sort of personal ethics in their mind when they are acting as directors. Okay, so there are 4 moral duties of directors. The first one, so ICA can intentionally tell you or ask you a question: what is the moral duty of the CEO? Or what are the moral insights or the moral behavior, right? Or the moral ethical behavior, personal behaviors of the CEO is the same thing. Okay, so first of all, you must have conscience. You have a moral duty to listen to your conscience and make decisions that align with your ethical values. Okay, the transparency, fairness, accountability, integrity, right? You have to, I get it, act in accordance with your personal and professional integrity, considering the impact of your decisions on stakeholders and overall society. Then inclusivity. You have to promote inclusivity within the boardroom and ensure diverse perspectives are heard. Include everyone. That is one of your moral duties, to include everyone, right? Foster an inclusive environment that values different backgrounds, experiences, and viewpoints, leading to more informed and balanced decision-making. Don't just focus on a group of people, include everyone who is required, right? So the next is what? Competence. You must have a moral obligation to possess the necessary skills, knowledge, and expertise to fulfill your responsibilities effectively. So you should continually enhance your understanding of the business, industry trends, and governance practices to make what? Informed decisions. The next one is what? Commitment. Okay. So commitment, you have a duty to demonstrate commitment to your role and the organization that you serve. Also, you should dedicate sufficient time and effort, attend board meetings, actively participate in discussions, and stay informed about key issues affecting the company. Then you should have courage as a director. Also, a moral obligation to act with courage and speak up when you believe something is wrong or is unethical or against ethical principles. So you should have the courage to what? Challenge prevailing opinions, raise concerns, and advocate for what? Responsible and ethical behavior within the organization. So when it comes to what? The moral duties of the director, conscience, including people, inclusivity, commitment, and also competence, courage. Also, please remember these ones. Then we have the board chairman. What is his role? What is his role? Now, every chairman should be what? Running the board, setting its agenda, ensuring the board receives accurate and timely information, ensuring effective communication with shareholders, allowing sufficient time for discussion of controversial issues, leading the board development and facilitating board appraisal or appraising performance, encouraging active engagement by all board members, and reporting on and signing accounts. Is that okay? Please remember the role of the chairman. Rela no? Also, so Rela. So, also running the board, ensuring board receives accurate and timely information, ensuring effective communication, allowing sufficient time also for discussion of controversial issues, leading board development, encouraging active engagement, reporting on and signing off the accounts. Now we have, this is the role of the chairman, but who is an effective chairman? Are you getting it? So when it comes to, yes, you can be a chairman, but you may not be effective even after doing all this. So what do we have to see to say that this is an effective board chairman? A board chairman must uphold the highest standards of integrity and honesty, or what we call probity. Now, leading what? Board discussions to what? Promote effective decision-making and constructive debate. You must be able to, as an effective chairman, you must be able to foster effective relationships and open communication between executive and non-executive directors. You must be able to build an effective and complementary board which will initiate change and plan succession. You must promote the highest standards of corporate governance. You must ensure a clear structure and effective functioning of the board. Okay. You must also ensure the implementation of the board decisions, establish a close relationship of trust with the CEO, be able to provide support and advice while respecting his executive responsibility. Also be able to provide coherent leadership in the organization. Okay. Now we have seen the chairman. What about the CEO? The CEO also has some roles that he needs to play. We are looking at these two things to know the conflicting roles of the CEO and the chairman, and when we need to separate the roles of these two people, because most exam questions are going to be centered around those areas. So the role of the chief operating officer, I said chief operating officer, chief executive officer, also includes one, setting business strategy and the management of the company. So business strategy and management. The CEO is responsible for developing and implementing the overall organization strategy and ensuring that it aligns with the mission and the vision of the organization. They also oversee the day-to-day operations, drive growth, and make key business decisions. The second role of the CEO is investment and financing. The CEO plays a crucial role in financial management, including allocation of capital resources, taking decisions, basically investing in positive NPV projects, that's investment decisions, or disinvesting from a non-profitable project. It's also a disinvestment decision, is an investment decision, and securing funding for the organization's activities, which is a financing decision, right? So they work closely with the finance team to ensure sustainable financial performance. Also, one of the roles of the CEO is risk management, okay? The CEO is responsible for identifying and managing risks that could impact the organization's objectives. They develop risk management techniques, establish risk mitigation measures, and ensure compliance with relevant regulations. Okay, so identify and manage the risk, and also develop strategies for managing the risk, and also and ensure compliance with relevant regulations. Also, they have one role as serving as a member of board committees to also provide support to the board committees, like the audit committee, compensation or remuneration committee, and nomination committee, which deals with bringing directors or nominating directors onto the board. Now, let's look at splitting the roles between the CEO and the board chairman. Now, the chairman we know runs the board. and the CEO runs the company. The running of the board should be separate from the running of the company. Please note this. Hence, the role of the chairman and the role of the CEO should not be performed by one person, as this concentrates excessive power in the hand of one person. The chairman should be independent like an NED. So this is one of the reasons why we should separate the role of the CEO and the chairman. Now, they can ask you in a question, why should we split the role? Not so, or advantages of splitting the role. Now, segregation of duty leading to improved governance, okay, because now we've given them their respective roles too. Higher shareholder confidence, as the chairman is normally an NED, and it can also, the chairman can be able to challenge the CEO's views and performance, because now he has a separate role from the chairman. The directors can also communicate with the chairman if they have concerns relating to the CEO. If the CEO is fooling, they can talk to the chairman. But if it's one person, it's the same person fooling, he cannot advise himself. The CEO can also concentrate on running the business without spending time to manage the board's activities, so that the chairman will be doing that, right? It can't be the same person. The disadvantage is that the separation can create two leaders rather than unity provided by one leader. Okay, both of them see themselves as Oga. Because of that, one may not listen to the other. Sometimes chances of disagreement or clash between the chairman and CEO, because remember, Oga means two Oga from 1 to 2, it may cause a problem. And sometimes the chairman may not have in-depth knowledge of the business, right? So it may be a problem. But when he's the same as the CEO, then he'll know how to run the board and what issues should be discussed or pertain to the organization's greater performance in the long term. Now, the reason why we can split their roles involves some reasons, right? They can ask you. So remember, when they ask you splitting the role of the board chairman and the CEO, remember to talk about it this way. You can look at it by looking at the advantages and disadvantages, or you can look at the reasons why we may split their roles. One, they are demanding roles, right? So one person may default. So both the chairman and the CEO have demanding roles that require leadership, decision-making, and accountability. So they work collaboratively to ensure effective governance and organizational performance. So if the role is one, it may bring a heavy workload. Two, symbolism of different authority. The CEO holds the authority for day-to-day management and operating decisions, while the board chairman holds authority over the board's functioning, ensuring proper governance processes and representing the board's interest. Okay, so because they have different authorities, it is appropriate for them to run separately. Two or three, conflict of interest. Clear roles and responsibilities will help mitigate conflict of interest between the CEO and the board chairman. So separation of powers and independent oversight contribute to ethical decision-making and transparency. Now, you can say that the chairman can watch the activities of the CEO closely, and there will not be any conflict of interest. Then we have true accountability. Because the CEO is accountable to the board for the organization's performance, while the chairman is accountable to the shareholders and stakeholders for effective governance and oversight of the CEO's action. So the CEO can actually be now accountable to the chairman and to the greater board. Why? Because he's not the same person as the chairman, which brings unfettered power in one person's hands. Also, it can lead to proper oversight and monitoring, because the board chairman will oversee the CEO's performance and ensure the CEO operates within the framework that is set by the board. So they provide guidance and support while maintaining independence. The next is effective expression of board concerns. The board chairman serves as a conduit between the board and the CEO, conveying the board concerns, facilitating communication, and ensuring that the board decisions are implemented effectively. If his role is not separated from the CEO, he cannot do this. So when it comes to the separation of the role of the CEO and the chairman, these are some of the issues that you can raise to get your marks. Okay, so that is about the CEO and the chairman. Let's move to our guys, which is the non-executive directors. Who are they? These are part-time directors who are independent most of the time. They are not an employee of the company. That's what independence means. They bring independence, that's external perspective and scrutiny. They add to the confidence to shareholders by occupying key positions in various board committees. They get a fixed fee for being what NEDs and are not entitled to any bonus or shareholders, share options. I get it, as this will create a what conflict of interest, and they may not what work to the appropriateness of the company. So they get a fixed fee for being what an NED. So what are some of the roles of the NED? A common question that is asked in almost all corporate governance exams, the role of the non-executive directors. One is strategy. Non-executive directors, this is their main role, that's why it came first. They contribute to your strategic discussions where they provide diverse perspective and independent insight because they come from varying industries. They have vast experience or different experience. They challenge and support management in developing and implementing strategic initiatives to achieve your corporate strategies. Two, performance management. Now, NEDs monitor the performance of the CEO and executive team and ensure alignment with organizational objectives and holding them accountable for delivering results, right? Because now they can hold you accountable. Did you do what you were supposed to do? Another role of non-executives is risk. They participate in identifying and managing risks, ensuring robust risk management frameworks are in place, which is supposed to be done by the board. Remember, we talked about this. And one of the CEO also has to be able to what? Manage the risk. Remember, so he does it together with what? The non-executives in a risk management committee. Even if they don't have it, they don't have a separate risk management committee, the board must talk about it. They also are engaged in what? The appointment and remuneration of executive directors. Now, non-executive directors are involved in the appointment process of executive directors, ensuring appropriate selection and criteria, also appropriate selection criteria and procedures for bringing new directors on board. So they also play a critical role in determining executive remuneration to align it with performance and shareholder interest. Okay, so let's look at the advantages of non-executive directors. Why should we have non-executive directors? One, remember they bring what? External experience and knowledge on the board, right? Diverse backgrounds, expertise from outside the organization, and they can provide insights and perspectives that executive directors may not possess because they come with different views, right? And their external experience can actually contribute to better decision-making and strategic planning. Also, another thing we can consider for non-executive directors is the wider perspective that they offer, a broader view of industry trends, market dynamics, and best practice, okay? They bring fresh ideas to the boardroom. They can promote innovation and adaptability. The comfort factor is one of the reasons, right? They provide a sense of reassurance to the shareholders and other stakeholders that their presence on the board will ensure what? Checks and balances, right? It's not going to put power in the hands of just one person. Because of that, what do we call it? The stakeholders are going to be satisfied that if this guy will be there and is going to check what this guy is doing or what the executives are doing, then we are all going to be fine, right? Because nobody is going to steal from us. That is one thing that you have to look at when it comes to these activities. Now, also, strong independent element on the board can give people what assurance, okay? And non-executive directors are expected to act independently, free from any undue influence or personal bias. I get it. Their presence will actually strengthen corporate governance by providing objective scrutiny and challenging management decisions. So what are some of the problems that the non-executives pose? Okay, so we said that one, they bring experience and knowledge on the board. They bring a wider perspective. They make people comfortable, or they bring credibility on the board. Are you getting it? There are some certain roles that are what reserved for non-executives. For instance, within the board committees, things like audit, remuneration, and nomination, compensation. Are you getting it? All these things mostly is non-executives who are concerned with it. And it makes the board independent of some sort because we have different views and we have people who are not connected with the organization. Okay, so these are why we must have non-executive directors. Okay. Now, because these things are theoretical, even if I'm speeding a bit, when I share the video, you can rewatch so that you would watch and watch again and get used to them. So that when we are actually applying cases, rather, you grab that aspect. Because this is just theory, and when you see the point, you even understand. So I wonder why people said I'm going fast. These are principles that you can see my screen and you can read the point as well. So I read, I explain, you said I'm running fast. That's what I don't understand. So do you want me to go slow? Okay, no problem. So problems with non-executive directors. One, sometimes a director who is a non-exec can be a non-executive and still not independent. Okay, so how do we say a director is not independent? They may have some personal or professional connections that will compromise their independence. Okay, so this can undermine their ability to provide unbiased advice and oversight because maybe his friend is the CEO, his child is the CEO, right? This can be one of the problems too. There may be prejudice in their recruitment. Okay, so there may be resistance to expand the recruitment of non-executives beyond the board's proposed candidates, right? Because of the independence issue now, that's what brings these things. Okay, so sometimes we may exclude stakeholder representatives, and this limits the diversity of the perspectives and the potential people we can bring on board as non-executives. 3, attraction to well-run companies. Now, high caliber non-executive directors may prefer joining companies with strong governance practices, right? Leaving organizations who actually need their expertise. I get it. So these organizations who actually need NEDs do not get NEDs because they want the companies who are actually doing what? Who are actually doing well. Sometimes it will be difficult imposing the views of the non-executives. Okay. Now, when it comes to non-executives, sometimes they have challenges influencing the board's decisions, especially when there's a dominant executive team, because you know sometimes the non-executives, remember, it comes at a cost. So there are only few non-executives. If that is the case, you see that the executive board will sort of try to shut the non-executives up. You get the idea, because Musa, you are small, so keep quiet and let's do our thing, right? And sometimes they do not have enough time, so they do not stay on the board when you need them. Sometimes they are at other places. They are also directors, they are also employees, so they have other professional commitments. So having the limited time they can dedicate to the organization, this constraint may impact the availability and involvement in the board activity. So we have been talking about non-executive directors for some time. Are you getting it? But when we say a non-executive director is independent, what are we looking at? Okay, so in Ghana, we have specific rules, which we'll come to corporate governance again when we are solving a lot of cases and other things. I just want you to have a general overview of everything so that when we are solving questions, you can all bring different minds and perspectives on board. And sometimes we have to revisit the textbook, look at what is there and add it to our toolkit. So don't worry, just for now, just relax. Just be open, right? Rewatch the video when I post it, make your own notes from it, because you need this. As we solve more and more cases, you need this knowledge. It's not something that you know and that is it. We covered today and that is it. As part of our solving of cases, we will come across corporate governance a million times. So if you don't know it now and you just want to sit down and just know, say, we have finished corporate governance, it's not like that. It's something that we are going to be doing day in, day out. So as time goes on, it will now stick. I don't expect everything we've done today to stick in your head. So please relax. It's like people think we are just finishing up. No, I need you to have the basics, right? So that when we are solving questions, you can bring the little that you have learned on board so that we all are on the same page, right? So don't be scared. I'm there for you. With God being in control, we'll be fine. Don't be scared. That's what I'm trying to tell you. It's like some people are scared, Relax, relax. We just started. Relax, you'll be fine. Is that okay? So don't be scared. Now, I just want you to all have different views. So by the time we are going through all these things, we will all have different views. We all bring our minds on board based on these things that we have done. And when we start solving cases, you will not be idle because you have an idea who the board of directors are, what they are supposed to do. So when I'm doing strategy and I said, let's do corporate strategy. This is what and what the board is supposed to do. You'll be like, oh, okay. So that's why we're looking at the board of directors and independence. This is what it means. Yes. So relax. Is that okay? Please relax. Don't be scared. Me, when I cover a topic, I've not actually covered it. I want you to have an idea about what it involves or what it entails. Now, when we are solving proper cases, we'll start putting these techniques into play. Is that okay? Nice. Now, the independence of the board, okay, in Ghana, we have specific rules. So when we come to the ICA book, we'll look at it. But generally, when the director has no, the independent, the non-executive has no business or financial connections with the company. So when he has no direct business or financial relationship with the company or his directors, apart from his fees and shareholdings, he is considered independent because there's nothing that can bring him conflict of interest or hold him to lie, right? Or gain some personal interest. Also, exclusion from incentive schemes. We do not give them incentive schemes so that it will create a potential conflict of interest. He doesn't have any shares or whatsoever. No, so. Now, appointment on specified terms. Non-executive directors are appointed for a specific term, and the appointment is not automatic, right? This practice ensures regular evaluation of their performance and contribution. If they are not performing, we let them go. Now, board nomination and selection. The board as a whole, rather than a single individual, should be involved in the nomination and selection process of NEDs. Even the group that selects NEDs are NEDs, right? Which helps maintain objectivity and prevent undue influence. They should also have access to independent advice, okay? So non-executive directors should have the ability to seek independent advice if necessary at the company's expense, like seeking legal advice and other things, right? This ensures that they have the necessary information to fulfill their oversight responsibilities effectively. So when you see a non-executive having these qualities in a question, it means he's independent, okay? We'll come and look at independence later when we are looking at something like some heavy cases, and even your precinct will do corporate governance again. So I don't know why people are scared. Don't worry, it's just the start. So as part of, we've looked at the various people on the board, their rules. Now on the board, we have committees, right? So there are some key board committees like the nomination committee, which recommends appointment of new directors. Sometimes they are called the, I've even forgotten the name that they give. I've forgotten the nomination or appointment committee. Yes. Then we have the remuneration or compensation committee. It depends on where you are from, right? This remuneration committee recommends remuneration policy for the executive directors. Then we have the audit committee, which reviews your accounting and internal controls, liaising with external auditors and supervising your internal audit function. And we have the risk committee, which oversees the risk management process, okay? So not every organization has all of them, but the key ones are the nomination, at least, the remuneration, and the audit committee. Some companies do not have a separate remuneration committee or a separate risk committee. It depends, right? So sometimes ICA can ask you, what are the advantages of having board committees? When you have board committees, you become more focused and specialized because everybody will pay attention to where he has a specialty. And more time can be spent by the committees as full board has limited time. There may be higher involvement by the NEDs, like in audit or remuneration committees, and the board can focus on more strategic and business matters. And one issue that you must understand here is that when you have board committees, it can increase shareholder confidence. Is that okay? Now, let's then look at what we are required to do in each of the committees. Okay, let's start with the nomination committee. Now, the nomination committee makes recommendations of appointment of directors to the board, right? With the objective of maintaining balance. This committee will, majority of them will be NEDs. At least you may have just one, at most one executive on board, right? But the rest will be non-executives. The procedures for nominating directors to be formal, rigorous, and transparent. No bias, right? The person coming is not somebody's friend. It's somebody who has the necessary skills that we need, okay? So they determine the right size of the board, ensure the board contains the requisite knowledge, skills, and experience. They create a balance between executives and non-executives. Also, they look at the diversity of the board, how diverse the board is. They identify and attract competent directors to fill any vacancy. They do induction training and continuous professional development, which is CPDs. And they look at succession planning of directors, where directors need to go, how are they coming on board, right? So how do they recruit new directors? When there's a personal connection or sometimes word of mouth of directors and the senior management, they can contact the person. Sometimes they can use what employment agencies or executive search companies. They can do advertisement on the media. They can do some through professional forums and networks also. These are some of the ways that what they employ directors. In Ghana, we have the internal candidate model and the external candidate model. Are we okay? So these are some of the things that you look about or talk about when it comes to the nomination committee. Now, the next one is the remuneration committee or compensation committee. Now, the remuneration committee recommends the remuneration policy for the directors with the purpose of attracting, retaining, and motivating directors to achieve longer-term returns for the shareholders. Now, the committee consists of 100% NEDs. Why? Because it involves money. And once executives are there, they may want to build their own wealth. That is why the remuneration committee is only made up of non-executive directors. Is that okay? So that the committee can be independent while determining the remuneration of the CEO and the other executive directors. So an appropriate portion of the package should be linked with their performance to ensure that these guys will perform to the utmost best to maximize the shareholder value. What is their role? They determine the remuneration policy in order to attract, retain, and motivate, to also ensure that a portion of the package is linked with performance as well as linked with the long term. I get it, so that the guy will enjoy and would not want to what do bias. They also decide remuneration package for the CEO and all the executive directors. The remuneration policy is also reported, and packages, I get in it, that are given to the directors are disclosed through a remuneration report to the shareholders, so they know what is going on, whether they are not being cheated. Then it comes to the most important one that they are going to ask you a question about. But before we look at the other committee, let's look at what goes into the remuneration, right? How do we remunerate or pay directors? Now, anytime that you are trying to pay directors, okay, you must make sure that the remuneration you are paying them is sufficient to attract them, retain them, and motivate them. You should pay them something they'll be happy to do the work because they want more of. It should be in line with market rate. It should be at arm's length, right? Industry norms, and like that of their close competitors. It should have the following components. You should have a fixed pay, a variable pay, or a pay that is in line with your performance-based incentives. There should be short-term incentives like a bonus. I get, apart from its fixed pay, it should have something like a bonus or share options, which has to do with longer-term incentives to sort of bridge the agency theory. Are you getting it? It should consider difference in experience level of the directors. Based on his experience, it should be paid more and so on and so forth, right? The director can never approve his own remuneration. Remember, that's one principle you should know. So you see it in a question, it means that it's a weak approach to corporate governance. I get, and this should be done by the remuneration committee, not the director. So there are cases where you see the person has been doing it, he sets his own salary. Now the business is growing, he doesn't want to step down, he's still doing it. Ask, comment on it, you use the heading to talk on it, right? So also, we disclose fully to the shareholders, I get the amount of reward that is given to the directors. Okay, it's in their corporate governance report. Now, there are some components of a remuneration package, okay? We have a basic salary, which should be comparable to the market rates. We must have some benefits like what? a car, maybe accommodation benefits, vehicle benefits, a club membership, and also benefits in kind. Then apart from that, we should give them some retirement benefits, right? Like pensions, SNIT. We should contribute to SNIT for them, right? Very important. Then we have performance-related pay, like the short-term incentives, the annual bonus based on some level of profitability you achieve, long-term incentives like what? Share options, long bonuses, bonus payments based on their financial performance, and also non-financial targets can be there, like if you're able to achieve customer satisfaction on market shares. I get it. We consider that. Then sometimes you may consider to retain these directors, okay? You may consider to retain these directors by giving them what? An attractive package, a loyalty bonus. Let's say if you stay with the company for 5 years, you get this amount of Ghana Cedi bonus or gratuity. Not so. We give them a longer term bonus, which is performance-based or share options. All these things are ways we can what? We can boost directors, not so, to stay with the company. Now, a normal one that we talk about is mostly the share options. Okay, where you're giving people share options, they are longer term incentives whereby directors are allotted company shares, which they can only sell after 3 to 5 years, which is their exercise date. Okay, so that is even tying you to the company. You can't leave the company and you have to work to make sure that there are some conditions. Mostly we do this under IFRS 2, share-based payments. Okay, so the share prices should increase over time due to growth and profitability of the company, meaning that he will have to, because he wants his shares to increase, he will have to work and make sure the profitability goes high so that the price will go high. I get it. So it motivates the directors to stay with the company and focus on creating longer term shareholder wealth. What are some of the factors influencing the level of reward of CEO and directors? So depending on the size of the company, remember, small companies normally pay less. Public sector or private sector, right? Public sector pays less, right? Compared to private sector. And the profile and experiences of the CEO and the directors, right, will also tell you how much they are being paid. The commercial organization or not for profit, commercial organizations they tend to pay more, right? Then company's performance and the target achievement of the objectives, the target achievement or objective achievement can also tell how much directors will be paid, as well as market rates. So benchmarking with similar companies or competitors in the industry can also tell how much the directors make. Okay, so these are issues about remuneration and then the nomination committee. Now, when it comes to the audit committee, it is responsible to ensure that financial reporting is accurate, internal audit function is effective, and external auditors remain independent. So this committee, when they exist, everybody is satisfied because they ensure that your financial reporting, internal reporting, and internal control roles are independent, right? And we are doing the right thing. So when people hear that your organization has what audit committees, they are satisfied. Are we okay? This is to ensure that shareholders receive independent and accurate financial information of the company. Now, what are the rules? First of all, they deal with financial statement and reporting. They ensure accuracy and integrity of financial statements and regulatory filings. They review accounting policies. They review the internal controls set by management relating to financial reporting, and they comply with the relevant laws and regulations, make sure tax returns are filed on time, SEC returns, whatever, right? That's their role. So when it comes to financial statement and reporting, that's the role of the audit committee. Two, when it comes to internal audit function, they ensure independence and objectivity of the company's internal audit. They appoint internal auditor and monitor his performance. Remember, the 5 factors of the internal control system, the crime that I talked about, the control activities, risk assessment, information system monitoring, and environment, they ensure that all those things are in play, and then the internal auditor is doing his job. They also approve the annual internal audit plan, just like the audit plan. They ensure effectiveness and efficiency of the internal audit function, whether he's doing his work well, and ensure that internal audit recommendations are implemented. So when the internal audit wants to implement a new system, he has to send it to the audit committee for approval. That's what they do. Then they also manage external auditors. So for external auditors, They recommend appointment, reappointment, or removal of the external auditor. They approve the terms of the engagement or audit scope, audit fees, all are decided with, they will go to the board, decide, and then speak or decide, talk to the external auditor. They approve the auditor's remuneration, as I was saying. They also ensure independence and objectivity of the external auditor. They review any non-audit services provided by the external audit, like tax consultancy, maybe tax health check, due diligence assignment, any other thing that the auditor has to do, we have to decide with the audit committee. Now, audit closure meetings, which we call exit conference, and even entry conferences, including discussion issues and weaknesses identified during the audit, which we report in the management letter or internal control weakness letter, right? All these things, we send it to the audit committee. And they also provide whistleblowing arrangement to prevent fraud and misreporting. When they see somebody is doing something fishy, they can report it. So this is the role of the non-executive directors. I get in it in the remuneration, audit committee. Now the audit committee, when we look at the composition of the audit committee, right? We have at least 3 NEDs. Okay, this is a role, this is a composition, at least 3 NEDs. One with recent financial experience. Okay, so we are saying that, okay, we have 3 NEDs, but we should have at least one who has worked in the financial sector before, because you are coming to deal with financial people like auditors and the rest, right? So one with recent financial experience. Okay, so in summary, the role of the what do we call it? The audit committee, you can remember Sister Clarissa. You can remember Clarissa, okay? So one, they create a climate of discipline in the organization. So climate of discipline within the organization. So people are scared to make mistakes within the organization. L, they lend credibility in financial reporting and internal audit, right? Or internal control systems. 3, they assist the chief financial officer to provide forums on board, on the board of directors. One, because we have one who has recent financial, at least one who has recent financial expertise, okay, and he can help the board. Then 4, we have R, also they review the financial reporting and internal control needs of the company, okay? And then we have V, Clarissa, independent. So we view them because they are NEDs. We expect the audit committee to be independent NEDs. Then we have S, they strengthen the position of the external audit, okay? So if external audit is doing his work, he knows that nobody can compromise his position. Then they strengthen the position of internal audit as well. And finally, they assist to resolve disputes. They assist to resolve disputes between management and auditors. So when you hear audit committee, remember Clarissa, okay? Sister Clarissa. Create a climate of discipline in the organization, lend credibility in financial reporting and internal controls, assist the chief financial officer to provide forums on board, review the financial reporting and internal control needs of the organization, independence, strengthen the position of external audit, strengthen the position of internal audit, assist to resolve disputes between management and the external auditors. So that is what I wanted us to know about corporate governance. I know the material is a lot, but make sure you watch the video again and again. So I think you can unmute now. If you have any question, Or I should wipe the board if you want me to wipe the board too. So any question? BBID. Yes. Any question? Hello. You can unmute and talk. You can unmute and talk. Please unmute. Yes, boss.
I beg you, you're an humble appeal. Can you please?
Can I please what?
Go through the Clarissa again. Clarissa, the role of the
I've
audit
written
committee.
it. I said they create a climate of discipline in the organization. They learn credibility
Okay.
in financial reporting and internal controls. They assist the CFO
Okay.
vice parents on board. They review the financial reporting and internal control needs. They are independent. They strengthen the
Okay.
of the external audit, strengthen position of internal audit, and finally, they assist to resolve disputes between the auditors and management. So see, this A, right? Clarissa. Are we okay? Somebody said, Prof, let me see. Prof, I learned somewhere that the independent director are usually the ones appointed by those with minority interest. Is that the case? It may and may not be. It depends on the kind of structure the organization goes with. Remember, as well as this corporate governance goes, your company constitution and your company, are you getting it? Approach to governance also counts. Yes, it may be the case that your minority may decide on that, but it's not always the case. You get it? Yes. So it depends on the governance mechanism that you are operating. Okay. Any further questions? Any further questions? Please ask questions. So, Anna, the matter over you, eh? He over you. Corporate governance don't over you. Yes, I'm listening. Oh. Any questions? If you don't ask me questions, I will ask you questions, so, and you're expected to answer. Yes.
Prof.
Yes, boss.
I saw one in one of the past questions that it was stated that it differentiate the board of directors with regards to Ghana and that of UK, the difference.
Board of directors with regards to Ghana and the UK. And which past question was that? Because
Yes.
it's rare for them to ask you such a question.
Okay, I have to check and get back to you.
Yes, so look at the
Let me check.
context of the question. Why I don't think they will tell you board of directors with regards to Ghana. They may have given you a specific code. You get it? Maybe according to the Higgs report or something. So look at the question very well. Are we okay?
Okay. Yeah. So
So
I'll check and get back to you later.
you're welcome. So now it's time. It's time to play the game, right? So remember, the reason why I'm doing this is to set a game for you. So are you all ready? Are we all ready for the game? Are we ready? Are we ready for the game?
Yes.
Hey, yes, nekra no nyadin.
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
The confidence is not there for me. Why? You are in good hands, so don't be scared. Even the starting point and look at the material we are covering. By the time we get to the end, you are very solid. Can you see my screen? So this is November 2015. Let's see what came on corporate governance. Okay, so let's see. If we see anything on corporate governance, we should be able to answer. So question number 3. Please read the question, then we suggest, right? Let's see. Okay. How many marks do we see there? How many marks do we see on our screen? Please, it's like I don't like the composure. I want you to pa, then we are gone. Is that okay? Please read.
Marks.
So the role of audit committee in corporate governance cannot be overemphasized. One, what should be the composition of an audit committee? I remember then somebody was writing about district assembly. So what should be the composition of an audit committee? We just learned it today. 4 marks.
It should be at least 3 non-executive directors.
At least one with
recent financial experience.
Nice. Explain 4 functions of the audit committee. 4 functions of the committee.
Clarissa.
I don't know Clarissa. If you read Clarissa, they'll mark you wrong. What is it? Mention the function.
Climate of discipline.
I don't understand climate of discipline.
They assist the CFO in discharging his duties.
Okay. What else?
This
of discipline.
They ensure climate of discipline.
They review financial reports.
They look at the rules. Ensure internal audit.
They ensure the independence of the internal auditors.
Yes, that is good. It's a good role.
They also strengthen external auditors.
How do they do that? They liaise with the external audit. They make sure that there's no conflict of interest. And also, they agree the fees of the external auditor. All these things are functions. We mentioned them, didn't we? So you see how corporate governance, the marks are huge. And this is where students fail. Last night, a whole number of students, if you could see their marks, 48, 48, 48, 47, 49, 48, 47, 49. Why? You know why? They messed up with 2 questions. One was the transfer pricing. All the other questions they did, one was the transfer pricing, and 2 was the governance and the risk. Complete. People are not so strong when it comes to corporate. I don't know why. Is it because it's too theoretical? Is it because it's too theoretical?
Yes.
That's why you have to
practice. Learning it is difficult.
Why?
Because it's too theoretical. Sometimes you have to do Baba.
It's part of the syllabus and it's a major area. Okay, so we have seen this, right? 4, 6. The next question is, corporate governance is now a very popular and important area in strategic management. However, corporate governance is poor in a number of organizations. Explain 5 symptoms of poor corporate governance. 10 marks. You see, the things I was teaching you today are just not hearsay. They are actually questions. So please, I'm listening. Yes. 5 symptoms of poor corporate governance.
Dual chairmanship and CEO position.
So in simple terms, unfettered.
That's one person. Okay.
Of one person. Okay.
Hello, sir.
Yes, boss.
We have domination by a single individual.
So domination by single individual or group of persons also, or simple small group, right? 3.
Manipulation of accounts.
Manipulation of accounts. Lack of committees, right? On the board.
Then lack of
what?
Lack of adequate control function.
Lack of adequate control.
function.
Inadequate control function, right?
Control, yes.
Emphasize on short-termism.
So emphasis on short-termism. Inadequate disclosures, right?
Lack of independent scrutiny.
No independent scrutiny, not so. Lack of transparency, not so. Transparency. Incompetent directors.
Inadequate. Incompetent and
Can talk about. I get it. So we say this, we get our 10 marks. You just explain it simply that one of the key weaknesses of corporate governance is where we have uncertain power in the hands of one person. For instance, if the role of the CEO and the board chairman are the same, then this can lead to. So you explain short, you are good to go. Is that okay? Any okay. Question 5B. Ghana has adopted the principles published by the OECD, NOSO, which deal mainly with the performance problems that result from separation of ownership and management of the company. Explain 5 principles of corporate governance. So what are they asking for?
Principle of corporate governance.
They are asking about
OECD
principles, right?
principles.
Were the rules that we saw under the OECD. That's how the questions come. That's how they come. And these are the same questions IC has been repeating day in, day out. I'll not lie to you. And we did this today. And what are the questions? What should we talk about? Let me give you one. The role of
The right
transparency.
Right of shareholders.
Equitable treatment of shareholders.
Equitable treatment of shareholders. What else?
Disclosure and transparency.
Disclosure and transparency.
Disclosure and transparency. And the last one?
The responsibility of the board.
That's the role of the board. So what's the last one?
So they have the role of the stakeholders.
The role of stakeholders. Okay. So these are the OECD principles of corporate governance. Okay. So this is what came under 2015. Okay. This is what came in 2015, November. Okay. Regarding corporate governance. So we move to May 2016. Let's see. May 2016. Let's see what came May 2016. It's loading. Let's wait for it to load. I don't know why. So why is my May 2016 not coming? I don't know. Hey, what happened? May 16. Let's see. 5B. One of the important tasks in the formulation of corporate strategy is stakeholder analysis. Explain the term stakeholders and identify two groupings of stakeholders. Yes, who are stakeholders? And give me two groupings of stakeholders. I think they brought more of ethics here. Groupings of stakeholders.
You have internal stakeholders and
We have
external
internal,
stakeholders.
connected, and then external.
Okay. Nice.
Internal and external.
Okay.
It's a committed aspect.
Okay, I'll take it. Now, let's see the question here. Please, let's read this question. At its recent annual general meeting, the management of NTM was highly criticized for the two major scandals that occurred in the organization during the year. In one case, newspapers reported that the management of the companies connived with officials at the port to undervalue imports in order to pay lower taxes. So, let me ask you, in terms of the corporate governance theories, which of the theories do you think is prevalent here? Which of the theories is acting here? The theories that we looked at.
That is agency theory.
Are you sure?
The
Okay.
transactional cost.
Transactional cost. Remember, transactional cost theory, lowering the cost, right? You could say that. In the other case, it was reported that the accountant leaked information to his friend who was bidding for a contract in the company. The board chairman, who is also the CEO. So we are identifying weaknesses, right? The board chairman, who is also the CEO, apologized for these incidents, but did not disclose that the company has been sued in respect of the first case. He went on to promise the shareholders that the fortunes of the company would change dramatically by the end of the new year, as the company was going to start exporting its products to Europe within the next few weeks. 1, identify 3 situations that are in conflict with the International Federation of Accountants. I haven't taught you code of ethics, so don't worry about that. But what are 4 disadvantages of the CEO acting as the chairman of the board? And identify 4 principal duties of the board of directors. I think all these things we know, right? So look at the marks, huge, 14. Wow. So what are we going to say? What are the disadvantages of the CEO acting as the chairman of the board?
Will be conflict.
So when you mention a point, you actually have to explain. When you say conflict, I don't understand. You have to throw more light on it. You are a senior financial executive.
Yeah, there will be a conflict because the CEO acting as the board chairman at the same time as the chief executive officer. It means he will be taking decisions that will, hello?
Yeah, I'm listening.
Oh, I thought my alignment off. Oh, let me come again.
Is that all? 4 disadvantages. The CEO acting as the
Hello.
board. Yes, boss.
Yeah, there will be too much power concentration.
Too much power concentration.
And this will lead to the CEO, yes, the CEO, the chairman, bullying his way through in some of the decisions that they will try to make.
Okay. 2 points. Yes. So yes, they said 4. I'm not speaking cry. Yes, we are all learning. We should have balanced view, right? So yes, at least 2 guys have suggested 2. 2 ladies should also suggest 2. Then we move to other questions. Yes. Maybe I did. Hey, I did I Wow. Okay, the men, please give me the answer. If the ladies don't want to talk, give me the answer.
There will be override of controls.
Override of controls. Can you throw more light on it?
Yes. The one person, two positions. When the CEO is responsible for running for the day-to-day administration of the business. But if the CEO if the CEO serves at the same time as the chairman, then there will be nobody who will be checking on the CEO's activities. So the CEO, the chairman or the CEO will decide to do whatever he feels he wants to do, and there will not be anybody to check him.
So shareholder concerns may be raised, right? About the governance structure. Are we okay? Because shareholders might raise concerns that, how come this is happening? Also, you know that there's going to be risk of autocratic decision making. Whatever he says is final. Do you all agree? Do you all agree?
Yes.
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 Limited diversity perspective. True or false?
Okay, true.
You know why? People to bring varying points because
ideas.
Yes, because he owns the whole thing, he may not want people to bring what? Different ideas because he is the chairman and the CEO at the same time. Conflict of interest. Not so. It involves the day-to-day management of the company as the CEO, while the chairman is responsible for representing the interests of shareholders and ensuring governance. When the same person holds the same roles, conflict of interest can arise because the CEO has to oversight, right? He has to oversee the work of the board, the work of the chairman has to oversee the work of the CEO. Because of that, that will be minimized, right? Also, all agree that there will be reduced accountability because you know the CEO is supposed to be accountable.
Sure.
So if the same person is the director, what happens? The same person is the chairman, what happens? Then he will not
no accountability to the board.
No accountability because it's the same person. Are we okay? So these are the things that you have to talk about, though there are other varying points like lack of oversight and other things, right? But these are some of them. Now, what are the 4 principal duties of the board?
Responsibility.
Risk management.
Okay. The responsibility.
Can we talk of strategy?
You have to frame it well. So remember, one of the rules of the board itself is what? The fiduciary duty. Remember?
Duty, okay.
Act in the best interest of the company. We have the oversight, right? Providing strategic direction. You can even talk about the setting of strategy, risk management, and also corporate governance. They are all roles, right? In terms of the responsibility you spoke about, you could have framed it in a different way. Are we okay? I hope that's
okay.
So,
we can talk about accountability. Yes.
Of course, but you can frame it in a way that will make it look more like what? A duty. I hope that's okay.
Yes.
So Walter Institute is a research organization with branches in 5 African countries. The major shareholder, Mr. Walter, though not recognized in the company's organizational structure, is actively involved in management. He gives directives and instructions to management and employees which are sometimes in direct contravention with the policies of the organization. Customers, employees, and management are often affected in various ways by the decisions of Mr. Walter. Preparations are underway to get the company listed on the stock exchange, and a consultant is needed to advise on the improvement of the corporate governance status of the company. Required, identify 4 stakeholders of the company and explain the nature of the interests of each company. And also, and explain to Mr. Walter what is meant by good governance, including the problems it is intended to address. So you see the question, very simple, right? I hope this one you can do it. Looking at the nature of the company and what it does, you can suggest some of the stakeholders, right?
Yes.
So who are the stakeholders here? Mr. Walter himself. We have management. We have employees.
Customers.
We have customers. Not
Customers, employees.
5 branches
management.
In 5 African countries. So definitely we have competitors, other research organizations, right? You see, the Ghana Stock Exchange is even
in the Ghana Stock Exchange.
And a consultant, right? The consultant is also a stakeholder. Do you get it?